levering in and going full bore on the bubble is often an imprudent move. I think you want to be careful with leverage here.
We just have these extreme moves in fundamentals, extreme moves in stocks, and that's creating volatility.
There is definitely a question on the sustainability.
We think the market ends higher at the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. It finally feels more like the middle of August in markets, with trading volumes falling and stocks struggling for direction. Investors hamstrung between blowout earnings and increasingly ambitious AI spending plans, with Intel selling new shares for the first time going back to 1971. Bonds pricing back in all that inflation and Fed rate hikes ahead, with oil prices climbing for a fourth straight day, Annmarie.
So you have inflationary concerns everywhere, no matter where you look, on the supply side and on the demand side. On the supply side, clearly oil moving higher because there's no deal in sight, not just a peace agreement, but to reopen the Strait of Hormuz. And now we're back once again to a hotter rhetoric, more demands from this White House and Tehran, and we're not seeing any end in sight there. At the same time, as you said, we have blowout earnings, and AI company after AI company is still tapping the market and saying, we are going to need more capital expenditures. We are going to need more financing when it comes to this entire trade.
It feels like markets are hamstrung between oil prices on one side, the inflationary pressure that is resurgent once again on a fourth straight day of gains for oil, and on the other side, exactly what you're talking about, all of this issuance, the $500 billion financing plan.
With little details.
With little details. It is a financing plan. Nonetheless, it might be the biggest ever privately financed plan to really emerge in one single type of arrangement.
Huge number, scant on details, but these executives indicating that they're ready to do this when it comes to debt financing. This is a huge amount of money. And once again, fears potentially of circularity when it comes to this space. And then Intel. We had this news out yesterday during the program when it came to Intel. Then by the end of the day, you see how much bigger that offering was. There is just so much demand right now to get in on all of these plays.
With Intel trying to preserve their credit rating, so taking their cues from the stock market instead. Beth Hammack of the Cleveland Fed really setting the tone ahead of the CPI print that we get tomorrow, talking about how she doesn't think that one rate hike is going to be sufficient to tighten monetary conditions. She sees several. She said it would not be appropriate to say exactly how many, but highlighting what markets are baking back in, that even the weak report that we got from the labor market on Friday was not enough to assuage concerns that these inflationary shocks, one after another, are coming too fast, too furious to really be ignored.
In her mind, she explained it like you're driving a car and you have passengers in the back of your seat and you see a stop sign ahead. Do you want to speed up and slam on the brakes as she views inflation and the trajectory of where inflation's going? Or do you want to slowly guide yourself towards that stop sign? That is why she says, I think now is the time to act.
Right now in markets, you do see a sense of ambivalence about which direction to go in after yesterday closing still about 0.5% away from all-time highs in the S&P 500. This morning, completely flat, unchanged, people being whipsawed in all directions. The NASDAQ is already about 2.5% below all-time highs reached earlier this year, getting a little bit of a bid there. And Russell 2000 actually having a harder time of it as people price back in some of those rate hikes. Again, it really does come back to the bond market, 2s, 10s, and 30s ahead of that 3-year note sale at 1 p.m. today, of $58 billion sale. You are seeing that ongoing creep higher in benchmark yields, led yesterday by the front end, today by the back end, seeing a 4.255% on the 2-year, 4.73% on the 10-year, and that 30-year yield so close to the highest level since 2007. Both because of oil prices and because of all of the debt sales coming from all of these companies, not just big tech, but the fastest pace of investment grade issuance yesterday going back to January. But when it comes to oil, very much setting the tone, Annmarie, and this is something we've been talking about, the idea that ongoing conflicts seem to be unconstrained at this point, with the questions about what the Fed's response mechanism is going to be, talking about charging Iran potentially fees for the damage they have incurred. Brent crude, $89.73. Coming up this hour, Marvin Lowe of State Street, as NVIDIA taps Wall Street for $500 billion in AI funding. IHG Hotel CEO Elie Maalouf, as the company's first half revenue gets an assist from the World Cup, and Kelsey Berro of JPMorgan on the high hurdle for pricing out rate hikes. We begin this hour with stocks kind of looking for direction as the flood of big tech debt keeps upward pressure on Treasury yields. Marvin Lowe of State Street writing, while recent data has thrown a bit of cold water on the strength of the economy, the strong demand for capital has created strong need for tighter financial conditions. Marvin joins us now for more. Marvin, great to see you. Thank you so much for being with us. Can you explain that, why all of the tech issuance is actually a requirement for tighter monetary conditions in and of itself?
Yeah, absolutely. I mean, I already mentioned kind of the supply and demand aspect of it. And, there is a supply issue that is arising ultimately with all of this AI build out. Ultimately, we look at inflation through the oil lens, and that makes clear sense. But also, we have to look at inflation through the chip lens, which is the demand for chips and the supply for chips is being affected by this capital raise and all of this data center build out. So it is ultimately interrelated. Ultimately, growth outperformance this year has very much been predicated on the fact that we've got all of this investment within the GDP stack, if you will, and there is no let up in that demand at this point.
So you're saying that regardless of what happens with the underlying economy or core inflation away from some of these key components, that monetary policymakers should be looking at the rapid record pace of issuance in the debt markets and, frankly, increasing activity in the equity markets as a sign that they are not restrictive enough, that this inflationary impact from AI has legs and is going to last for a longer period of time.
Yeah, absolutely. I mean, I wouldn't say that we can ignore the data, but I think that we have to take the data within the context of, everything that we're saying in terms of the capital demand in this environment. There's economic theories which say that, interest rates are supposed to be set where the amount of capital is equal to the availability of savings. And from that perspective, the demand for capital certainly are at levels that we haven't seen in quite some time.
Obviously, when it comes to the data, it's backwards looking. And for someone like Beth Hammack, and if you listen to her speak, it doesn't really matter what tomorrow's CPI print brings in terms of where she sees the trajectory and what needs to be done to really try to tamper inflation. How are you viewing tomorrow's CPI print?
Yeah, I mean, we're still going to be above targets for the 63rd, 64th month, if you will. There are questions as to whether or not the disinflation is going to get us to that 2%. And in an environment where you've got, again, kind of this economic tailwind from this investment balloon that we have, you've got to look at it holistically and parse the fact that we're still above those targets, and the shape of the curve and how long yields are responding are saying that there are concerns that you're not taking it seriously enough.
Given all of this money flooding into AI, given the fact that it is costing a lot more in terms of having compute, do you think it's going to be much harder for Fed Chair Kevin Warsh to have that argument that ultimately AI is disinflationary?
Certainly in the short term. Jackson Hole's coming up. He's going to talk about the big items that he referenced during the last FOMC meeting. We'll get a sense on kind of when that productivity can actually make its way into policy. But in the short term, it is going to be really, really difficult to calibrate the potential for productivity gains 5 years down the line within the environment that we have right now.
What would raising rates actually do on the front end of the yield curve, Marvin? I mean, ultimately, we've seen that even with rates materially higher, priced in by the market, with the market doing the work, as Kevin Warsh was saying, it hasn't really had a material effect on where equities are.
No, it hasn't, which ultimately is a tailwind for kind of this equity story. This isn't like prior investment cycles around technology where, certainly the technology itself has to be proven, but it's being embarked upon by companies that are incredibly cash flow positive, and that is somewhat sustainable. I think, ironically, showing that you've got this forward inflation fighting mentality is going to help the long end. It's really the fact that the long end, whether it's driven by term premiums, whether it's driven by real yields, are being unhinged by concerns that you're not taking it seriously enough. I'd look at that for the biggest win in raising rates kind of at the short end, if you will.
When do you see the long end of the yield curve reaching a point where it does constrain some of the enthusiasm that we're seeing in equities and, frankly, the ambitious capital expenditures that we're seeing from AI and, frankly, even other companies as well?
Yeah, so, 5% on the 10-year is always kind of that magic number that we're looking at. If it's driven by real yields, certainly getting real yields into this 125, 150 basis point range, we're closer to that, 80, if you will, perspective from a term premium viewpoint. That really starts to, I think, tamper the enthusiasm of how much you can throw at these long duration models.
Marvin Lowe of State Street, thank you so much for being with us this morning.
Thanks, Lisa.
Wonderful insights, as always, especially given the scope of some of the borrowing that we've seen. It isn't just the $500 billion NVIDIA financing plan, which is a financing agreement with 6 big Wall Street firms. Most of them are private asset managers who NVIDIA said they contacted and nobody said no. But yesterday was also the fastest pace of issuance in the investment grade market in the United States going back to January, with 19 separate issuers flooding the market trying to get in before that CPI data.
Right, trying to get in for CPI, trying to get in for PPI. We're going to see components on electronics and things like chip. Axios this morning talking about chipflation. Absolutely, that chart has gone vertical. This is why you are potentially seeing the yields rise. There's just inflation on all aspects of the economy right now.
And at what point does that yield rise present a real problem to the Fed and even more so to the Treasury Department? Right now, let's get you an update on stories elsewhere this morning. Here's a Bloomberg Brief with Vonnie Quinn. Vonnie.
Good morning, Lisa. At least 130 people are dead in Colombia after the country was hit by a magnitude 7.4 earthquake yesterday. More than 5,000 homes were damaged, 3 hospitals collapsed, and more than 180 people are missing in the Valle de Cauca province alone. NVIDIA is teaming up with some of Wall Street's biggest firms, including BlackRock and Goldman Sachs, in an attempt to unlock up to $500 billion for AI infrastructure. The initiative aims to provide financing for NVIDIA customers building data centers, power projects, and advanced chips. U.S. small business optimism rose in July to the highest level in almost a year as firms ramped up hiring plans and inflation pressures eased. The National Federation of Independent Business Index increased 2.4 points to 99.8. 8 of the 10 components that make up the gauge improved. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, hardening his position on Iran.
Iran is broke, totally broke. They asked for money for the damage that we've done. I said, that's a good idea. Well, we're going to ask for money for the damage they've done over a 50-year period.
General Karen Gibson of Academy Securities joins next. This is Bloomberg Surveillance. Good morning. Looking for direction after just hovering close to all-time highs. We're really about 0.5% away from that on the S&P 500, a little further away on the NASDAQ this morning. A little soggy around the edges as the market tries to adjust with inflation expectations now picking back up and potentially a slew of issuance only accelerating from AI. In the euro, a little soggy versus the dollar. A question: if rate hiking expectations get baked in, what does that do to the dollar? Does it strengthen it and make even more of a problem for some of the countries that are beset by oil prices even more so? 10-year yields just up by about 2 basis points to 4.73%. The danger zone, people say, comes around 5%. And crude, Annmarie, up 2.4%. There is a real question here about what has shifted to take negotiations not necessarily off the table, but they seem to be further pushed back away from the negotiating table.
I think the market was really starting to bake in that Oman and Iran could come to some sort of agreement, which you would actually see more vessels get through the Strait of Hormuz. And we're still not there yet. We've been talking about this now for weeks. At the same time, the president over the weekend, speaking to Axios, was saying we're low-keying it when it comes to these negotiations, kind of taking a step back. But yesterday he said, well, Iran's going to have demands and wants things like reparations, then we're also going to have demands. So you could see the two getting further and further apart. At the same time, the Strait of Hormuz continues to remain closed.
And the Houthis are getting more involved. Under surveillance this morning, hardening his position on Iran.
Iran is broke, totally broke. They asked for reparations, you might say, or they asked for money for the damage that we've done. I said, that's a good idea. Well, we're going to ask for money for the damage they've done over a 50-year period. If there's damages to be paid, I think Iran should pay those damages.
Here's the latest. Oil gaining as President Donald Trump makes new demands for Iran, saying reparations for past attacks will be part of any future negotiations with Tehran. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back. Great to see you. Do we have a sense of how much the tone in D.C. has shifted when it comes to Iran?
Well, Lisa, at this point, it's very clear that both sides are digging into their positions, and this White House is opting for that economic pressure campaign as President Trump now puts this new demand on the table, which includes that Iran would be responsible for compensation to Iranian families of protesters who have died over the last 50 years, he said, as well as that Iran would be on the hook to pay for any deaths or damages related to conflicts where its proxies operate, including in Lebanon, Syria, Yemen, and Gaza. Now, he didn't provide further details, but it came after Iran said that it was seeking damages for compensation for damages in exchange for the reopening of the Strait of Hormuz, keeping in mind here that we had heard the idea that funds would be allocated to help Iran rebuild from the war, but that was a precondition for potential curbs on Iran's nuclear program, not for a reopening of the strait. Now, amid this breakdown in the talks, it appears very evident that the U.S. isn't going to be in favor of moving forward here, as President Trump has instead said that he's going to tighten that economic grip. And we know that Iran's economy has been hammered when it comes to the conflict. Data reviewed by Bloomberg News from the central bank showing that year-over-year inflation has reached 77%. But Lisa, there's also, of course, the domestic pressure building here at home, as yesterday Bloomberg News confirmed that President Trump has extended that Jones Act waiver another 90 days in a bid to make it cheaper to transport critical materials like diesel, jet fuel, and gas.
Tyler Kendall, thank you so much for being with us, and it's always great to see you down in D.C. General Karen Gibson of Academy Securities writing, Iran is substantially weaker today than before the war began. However, it has gained considerable coercive leverage. Iran benefits when the dispute is framed as an issue between Iran and the U.S. General Gibson joins us now for more. General Gibson, I want to get your take just of the lay of the land. If you could zoom out and give us a sense of what has actually changed over the past couple of weeks as people reassessed whether talks were on versus now, where it seems like increasingly they're pretty far away.
Yes, so that's a great question, Lisa. I think, one, the talks are proceeding on two axes simultaneously. One is between Oman and Iran, and that's the mechanism by which the strait would be administered, the potential for either voluntary payments or some form of toll to assist with administration. And then the second tack is the more important one, frankly, the one between the U.S. and Iran, which is not about how it will be administered, but when it will open, with Iran insisting that the strait will not actually open until the United States makes some major concessions. And as we've just heard from Taylor and has been widely reported, these are concessions that are simply not acceptable to the United States. Some of them, like, removing U.S. military forces from the region or reparations. And then others, it's just unwise to agree to the entirety of this package when really many elements of it, particularly some of those economic aspects, are leverage that the United States will also need in follow-on negotiations that we hope will occur to look at Iranian nuclear curbs.
Well, what's going to be the response from this White House if they do not go forward with opening up the Strait of Hormuz and inking this deal with Oman?
Yes. Well, so as Taylor just highlighted, the Iranian economy, which was already weak before this war began, is really being hammered by this. The blockade doesn't help. The sanctions don't help. Additional pressure that could be applied. It's unfortunate it's not a broader multilateral effort, but the economic pressure and sustained military pressure on Iran could eventually compel them, perhaps, to shift their strategy. The issue is time. And domestically, and I'm not a domestic political analyst, but domestically, there are constraints that make it difficult for the United States, whether it's gas or oil pressures or midterms or pledges not to engage in a forever war, that make it more challenging for the U.S. to wait this out, which really, I think, is what it will require.
Amidst all of this, there was really a stunning story last night from the Washington Post about the president and his departure from NATO. I was with him in NATO in Ankara. And after he boarded Air Force One, the Washington Post reports that he was shuttled via an airport catering truck, typically used to load meals, into another aircraft, so as a decoy, so he could secretly leave Turkey. Is there a real threat on the president's life that you would be concerned about at this point?
Well, I think we've seen even domestically at people who have attempted to assassinate the president that there are real threats. And he's been on Iran's fatwa list for some time. I'm not aware, certainly, of whatever classified intelligence information may have been available to lead the Secret Service to believe that there was a potential imminent threat, a very viable threat in Turkey. Obviously, that's not something that should be disclosed if that were the case. But I would say escaping in a food truck that nobody noticed is a pretty successful evasive measure.
Yeah, absolutely. And General, I would just love to understand from you, have you ever seen or heard of anything like this in the past?
Oh, of a president in a food truck? No. Or, you know, it's a very deceptive measure. Creative, certainly, seemed to have been effective, but yes, unprecedented, probably.
And something that could get slipped into the next spy movie or movie about Washington, D.C., I'm sure. I am curious about your point that you're making, that it's beneficial for Iran when this conflict is framed as Iran versus the U.S. versus Iran versus the world, which is kind of how a lot of people are seeing it when it comes to closing the Strait of Hormuz. What's your take on why it has been framed so much as Iran versus the U.S. and how that could be changed?
Well, I think it's unfortunate. One of the anomalies of this conflict is that we did not build a broad base of support from allies beyond the Gulf. And even at that point, there's some question as to how much they were in on this plan to begin with. Previous conflicts across the Middle East and elsewhere, there's been more international support for what the United States has been doing. I think it certainly doesn't help the erosion of some of the trust with our allies. But a broader multilateral effort, I mean, as you point out repeatedly, this is very global impacts. In fact, the United States, aside from inflationary pressures, suffers less from the closure of the Strait of Hormuz than the Asian oil consumers or Europe. And so having broader buy-in, broader economic pressures, kind of like we had with JCPOA, a more multilateral effort would certainly speed the timeline, I think, of potentially compelling Iran to change its strategy.
How much more are the Saudi Arabians getting involved, given the fact that the Houthis seem to be repeatedly targeting them in the Red Sea? We saw that again overnight and seem to be more proactive in terms of a response.
Yeah, so I would say the Saudi threat, the Houthi threat to the Saudis is certainly more proximate to them than Iran. Iran has not been recently attacking Saudi oil infrastructure, although they've certainly threatened to do that previously. I think that's why Operation Freedom, the military escort mission, only lasted one day, was due to Iranian threats against the East-West pipeline. But the Houthi threat is more proximate, and the Houthi threat is long-standing. The Saudis and the Houthis have fought 2 wars previously, and those conflicts predate the Houthis' relationship with Iran as one of their proxies. That's a very thorny, perpetual security issue that the Saudis have faced, which, again, unfortunately, does not seem to have an imminent solution.
General Karen Gibson of Academy Securities, thank you so much, as always, for speaking with us. And a real question for people in markets right now is how far have some of the oil reserves been depleted? Has the cushion really been used up? And whether that's going to be a more important factor driving oil prices going forward?
Well, we're at 40-year low when it comes to the SPR. You still see gasoline hold above $4 a gallon across the United States. And you bring up a great point. Look at European diesel futures. They are jumping. So it's going on not just the Strait of Hormuz, but also Russia. Maybe this is what is going to be the crux to get other NATO allies involved.
And certainly affecting the bond markets over in Europe even more than in the United States. In the United States, we're seeing continued tourism coming up. IHG CEO Elie Maalouf, as strong hotel demand drives first half profits. We are so close to all-time highs. What the bar is to build on that seems to be getting a bit higher. Even with blowout earnings, we're seeing right now very August moves, low volume, low action, although building throughout the morning. S&P futures up about 0.1%, following their close 0.5% below all-time highs yesterday. Interesting to see what's happening with the Japanese yen. It is Mountain Day in Japan, which means that the stock and bond markets are closed. And Annmarie, I will say, I think we should celebrate Mountain Day here because it is a celebration of nature, and to go out and explore the mountainous nature of their land, which accounts for about 70 to 80%. And so markets are closed. I think we could do with that.
This sounds like a Jim Zelter kind of holiday. Go out, touch grass, go out, take a hike. You know,
think about AI and all of the spending that you're going to get and why that is filtering into bond yields, because ultimately that is what's going on. How much of this is tied to the oil story? How much of it is tied to the AI story? Right now on the long end of the yield curve yesterday, with the glut of supply seeming to take back some of the reprieve that we had seen in the long end of the yield curve. 10-year yields 4.73% at the longer yield, 30-year yields near the highest levels going back to 2007, ahead of that $25 billion bond sale on Thursday. And then, of course, oil prices are really coming out and swinging, fourth potential day of gains as people take a look at the ongoing conflict in Iran. And as you mentioned just moments ago, Annmarie, the lowest level of the Strategic Petroleum Reserve going back more than 4 decades.
And you think, how does the Fed just continuously look through this when, according to John Arthur's opinion piece today, he cited Oxford Economics, which did a survey amongst executives, and they assume that Hormuz will be disrupted for the foreseeable future. Expect this continue throughout next year, and almost a fifth say it'll drag into at least another year. So you could potentially expect higher oil prices for longer.
Yeah, at the same time, a lot of them are sort of a little bit more sanguine in that survey about exactly what this means for their business. The push-pull definitely causing some churn under the surface 3 hours away from the cash open. Here are your morning movers with Yahira.
Hi, Lisa. We're seeing that churn under the surface with HIM's shares. They are falling 6.2% after the company posted a bigger loss than Wall Street expected. Remember, this is a company that's built its weight loss business selling those cheaper compounded GLP-1s, but lately regulatory and legal pressures have made that much harder, so it's had to resort to selling brand name drugs on its platform, but those are less profitable for him, so margins came under pressure. The company also had to lower the top end of its full year profit forecast. Meanwhile, also reporting earnings was Rocket Lab, shares also falling down 7.5% in the pre-market after the company warned that its most important new rocket could face another delay. It's called the Neutron, and it's designed to go head-to-head with SpaceX's Falcon 9. But Rocket Lab is no longer committing to a launch this year, and that's overshadowing what was otherwise a strong quarter with record quarterly revenue and a better-than-expected sales outlook for the space company. And we end on this company, Riot. It is one of those Bitcoin miners that has transformed itself into an AI data center company, and it just landed a huge customer in Anthropic. It has signed on for a $9.1 billion deal to use capacity at one of Riot's campuses in Texas for more than 20 years. And having, of course, a major player like Anthropic sign on gives huge credibility to its data center business. So we are seeing shares up nearly 20% in the pre-market. Lisa.
Thank you so much, Yahira. On our radar this morning, NVIDIA tapping major Wall Street firms for $500 billion to finance its AI ambitions. The chip giant partnering with Apollo, BlackRock, Goldman, and others to structure massive debt packages using compute power as collateral. Intel, meanwhile, raising $20 billion in an upsized share sale. Sources are telling us here at Bloomberg the sale drew more than $100 billion in demand. The deal showing a resilience of investor demand for stocks along the AI supply chain. Those shares just a little lower, 0.7% in pre-market trading. And Apple reportedly on track to deliver its all-glass iPhone next year. Sources telling us here at Bloomberg, Apple will release special new models in 2027, marking the iPhone's 20th anniversary. countering an analyst report from Jefferies that the launch had been canceled. Annmarie, so many questions, including if you drop it, does it shatter?
I know, that's what I was thinking. Like, what is the tangible upside to having this phone? Because I constantly break my glass all the time. And I constantly have to get like a new outer box to try to protect this phone. So what is the point besides maybe it's a cool look, but actually is it going to be useful? I think the crux of the matter is via Mark Gurman, our own reporter, Apple's really clapping back to this Jefferies note saying, no, we are going to be on track for what sounds like a fancy, aesthetically cool looking new phone. I'm just interested to know, will it actually be more beneficial? Will it get individuals to want to go actually line up outside the Apple store?
Maybe they'll be able to use their all-glass iPhone to plan their next vacation, because vacations have been very much in focus. Maybe it's just Japan focused on Mountain Day, but a lot of people are traveling. IHG Hotels and Resorts reporting its first half results this morning with total revenue up by nearly 6%. The World Cup effect lifting the Holiday Inn owner, helping to offset some headwinds from the Iran war. IHG CEO Elie Maalouf saying, quote, we remain on track to meet full year consensus profit and earnings expectations. Elie joins us now for more. Elie, thank you so much for being with us this morning. I just want to get started on how much the strength really did come from the World Cup, sort of one-off event or a special event, versus widespread strength in the consumer, both in the United States and globally.
Good morning. It's great to be with you. Look, we did have a strong set of results in the first half. Our reportable segments revenue is up 7%, operating profit up 10%, earnings per share up 13%, and it was widespread. Yes, the World Cup contributed, and we said that in the second quarter in the U.S. it contributed 1% of RevPAR, but RevPAR was up 5.2% in the second quarter, and even when you strip back that 1 point, that was faster than Q1. The fundamentals in the U.S. are very strong. You've got high employment. You've got a consumer that's still spending a lot. You've got the record amount of private sector investment that you were talking about earlier, not just AI and infrastructure, but it's energy, it's manufacturing, it's pharma, it's reshoring. You've got clarity on the tax policy. You've got strong corporate profits. That all leads to money in people's pockets, whether it's corporate or it's leisure, and people are traveling. So the World Cup was a great event. It wasn't the only thing. It wasn't even the most important thing in the first half of the year. And we see the fundamentals continuing into the second half of the year into 27 too. Then when you go to Europe, you know, it's been a strong summer of people traveling to Europe, especially Americans. There's a projection that Americans will be up 5% traveling to Europe from last year on top of a record last year. And so I think that's really helped Europe business. In Asia, in China, in Japan that you mentioned earlier, we've had good travel, and all of that really, covered up for, fully and more than offset the impact in the Middle East. So it was really broad-based. It wasn't just the World Cup, which was a great event in itself, but really when you look at the World Cup, it's a continuation of live experiences that people are spending money on. It's live concerts, it's theater, it's art, it's restaurant and bar. And there's always another athletic event and a sports event coming somewhere, another concert tour, and we benefit from all that.
Elie, I'm curious how much came from the upper end of the K, right? You have a number of different types of hotels that offer at different price points. How much were the revenues being driven by the upper end of the income sphere?
Look, you're right. We have 21 brands that range from everyday travel with Holiday Inn and Holiday Inn Express to ultra luxury with Regent and Six Senses. And in the first half of the year, pleasingly, every single brand had positive RevPAR growth, occupancy and rate growth, and it happened in every single region. So we feel good about the breadth of our brands and the breadth of the consumer. That doesn't mean everybody's in great shape, but I think that the acceleration of the economy, and I think the acceleration of people's purchasing power has improved the situation in the middle class. And so we're seeing more travel in that, not just at the higher end. Now, the higher end, of course, has done even better, but I don't know that we can really talk about as much of a K economy as much as we can talk about the top 80% of households are doing better because, they're employed. You still, in the U.S. alone, 4.1% unemployment is very low. You're still talking about wage growth. You're talking about high financial markets. Earlier, you were saying that we're near a record again. And most Americans own their homes. And so you have high home ownership and the home values are going up. So there's a sense of prosperity. And within that sense of prosperity, where people want to spend their time and money is on experiences. A little less on goods, more on experiences. and travel is a big part of it. You probably saw the article in the Wall Street Journal yesterday, I think, that said that, Americans now, 55% of them have a passport. In 1990, it was less than 5%. It's just a change in how people want to spend their time and money.
You mentioned six senses, so I immediately think of Oman, because I know that's one of the most popular six senses in the Middle East. How long do you think this conflict can continue and you're still able to recoup the benefits elsewhere in Europe or Asia?
Well, look, you mentioned Six Senses, Ziggy Bay in Oman, which, by the way, is doing very well. It's still a destination that people are seeking. We have about 26 open in 19 countries, so our distribution of Six Senses is it's very broad and not really impacted by the conflict. I think, look, I've been to the region, to the Middle East, twice since the beginning of the conflict. I'm going again before the end of the year, at least once, maybe more. And when you're on the ground, you feel a real sense of normality. People are going to work, going to school, getting on with their lives. There is still a conflict, more in a tension state than it is in a hot war state. I think the general belief is we're past the peak of March, April of the conflict. And I don't know how long the current tension can continue. But the other thing you have to keep in mind that people in that region, the Middle East, they're resilient, they're courageous, they're optimistic, they're not unused to conflict and tensions. And even if this continues for a while, they're getting on with things. They're talking about growth, they're talking about new investments, they're talking about expansion. So I think that even if the current situation continues at the current level, you're going to continue to see a recovery that we started seeing after the end of April.
You've also said you want to look east. What are the expansion plans right now looking like in Asia?
I think we're very optimistic about it. While we'll continue to be very strong in North America and Europe, just the rates of growth are higher east of Europe. So you have, on average, a younger population, faster growing middle class, faster growing GDP, more investment in aviation, whether it's infrastructure like airports or airline networks. And so there's more growth in travel. And strategically, we've positioned ourselves like that. 60% of our pipeline of new hotels under development. So we have about 1 million rooms open, nearly over 7,000 hotels. We then have 35% of that in pipeline under development. So about 2,400 hotels. 60% of that is east of Europe. That's Middle East, India, Southeast Asia, China, Japan that you were talking about earlier, and everything in between. So yes, there is higher growth in that direction, but it's not just, East Asia or South Asia. It's all of that region east of Europe, and we're very well positioned to take advantage of that.
Putting all this together, given all the strength and given the demand, how much pricing power do you feel like you have to offset some of the increase in input prices that we see across the supply chain?
Look, we, as IHG Hotels and Resorts, are franchisor and manager. We don't own the hotels. We don't set the prices. It's our owners and operators of the hotels that set the prices. And it's very, very different by market, very different by market, by micro market, by neighborhood. So I think that it's a very competitive market, and prices are set really based on demand and supply, taking into account the cost considerations. So the whole cost topic is much more of a theme in Europe and in the US. When you go over to China, for example, it has been actually the opposite. There isn't really much cost pressure, right? It's been more about seeking a little more inflation than not having inflation. So I think that it's much more regional, much more localized, and it's always set by the current supply and demand dynamics. In general, if you look globally, room rates have not increased faster than the rate of inflation. So it's still within, say, the reasonable range of people's affordability.
Elie Maalouf, thank you so much for being with us this morning. IHG Hotels and Resort CEO Elie Maalouf there. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Gwynn. Vonnie.
Lisa, thank you. President Donald Trump laying out new terms for Iran, demanding reparations from Iran over past attacks, as well as compensation to the families of protesters who've been killed over the years. The president says it's a response to Iran's own demand for compensation. General Motors is selling its share of the planned $3.5 billion battery plant in Indiana to Samsung SDI, giving the South Korean company full control as weaker U.S. EV demand pushes General Motors to scale back. The companies will still develop next-generation batteries for future GM vehicles. New details emerging about how President Donald Trump flew out of Turkey last month. The Washington Post reporting Trump boarded Air Force One in Ankara, then moved into a catering container attached to the plane, which ferried him to a smaller aircraft that then flew him to Britain. That is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. And that is what Annmarie is focused on this morning, the entire morning.
Well, I think it's just a stunning development and we're just learning about it now. So for a few hours, the press thought they were traveling with the president and they weren't. And if you think back, the pool that day were told to cover their blinds. Why were we left out of the dark on this? And also, how serious is the threat on the president's life?
Yeah, well, it's something a lot of people are talking about. Up next, clearing the inflation hurdle.
This week's inflation number is going to be very important.
This will be the hurdle that probably makes the decision whether or not the Fed moves in September.
It's really that inflation picture that guides us to say this is not a time to be raising rates.
Kelsey Berro of JPMorgan Asset Management joins next. This is Bloomberg Surveillance. Seeing a pretty range-bound market this morning. Still, though, near all-time highs. Bonds really doing the talking right now, with yields inflecting higher in the wake of higher oil prices. 10-year yields 4.72%. Crude prices up 1.6% to $83.47 on WTI, raising questions about CPI tomorrow, PPI on Thursday, and just how much those price pressures continue. Under surveillance this morning, clearing the inflation hurdle.
This week's inflation number is going to be very important.
The CPI print and inflation prints going forward are really going to be the key.
This will be the hurdle that probably makes the decision whether or not the Fed moves in September. If you get a hot CPI number, that's going to create some problems.
It's really that inflation picture that guides us to say this is not a time to be raising rates.
Here's the latest. Cleveland Fed President Beth Hammack doubling down on last month's vote to raise rates, saying some number of rate hikes may be necessary to tame inflation. Investor anxiety rising along with bond yields ahead of fresh CPI data tomorrow. Kelsey Berro of JPMorgan Asset Management writing, the hurdle to price out rate hikes is high, with softer data more likely to push out the timing of hikes rather than to remove them altogether. Kelsey joins us now for more. Kelsey, can you explain this idea that even with disinflationary data, that may not be enough to say the Fed can remain on hold?
It may not be enough in the short term. I mean, so the one thing is just the calendar ahead, right? So we have the CPI report tomorrow, but then we also have Jackson Hole, and then we have another CPI report and another payrolls report. So the Fed has some time essentially to assess the next move. So one data point alone isn't going to be enough. But that being said, if we get the consensus expectations for core CPI, which is a 0.2 month over month, the 3-month, 6-month, and 12-month rates are going to be 1.7, 2.4, and 2.5. Those are, to me, really not particularly concerning numbers as it relates to inflation. The problem has been the translation to core PCE, which is running above 3%, and we can talk about that. This is a very unique time for the Fed, and the reality is the market is going to continue to price in hikes for now until we get a trend of multiple months of data that either confirm that inflation is maybe not as big of a problem, or, if things come in a little bit hot, the concept has shifted to this idea of insurance hikes. So if the labor market remains stable, there's limited cost to maybe moving rates up a little bit just to confirm that inflation is going to come down.
Fascinating to me that you talk about core CPI versus core PCE, and it sounds like alphabet soup, but core PCE includes some of the increases in component prices that we're seeing that are more directly tied to the AI build out. And it speaks to what we were hearing from Marvin earlier this morning, where he said part of the problem is that the market is so robust for these AI borrowers. They're issuing so much debt that this alone indicates that the Fed should probably tighten monetary policy. What's your response to that?
I do think you have to look more broadly. So the Fed is interested in credit conditions. That is one of the ways in which their monetary policy transmits to the real economy. And clearly, conditions for issuance within the AI data center build out is wide open, right? You can issue a lot of debt, but it's also coming at incrementally wider spreads. So there's both the availability of capital component and also the cost of capital component. And on the margin, investors actually are demanding a little bit more spread for that investment. When I look at it, and I look beyond AI. For example, we got the NFIB Small Business Survey this morning, and I look at CapEx plans, that ticked up. But if you pull back the series to the last 30 years, CapEx plans are actually still fairly muted. If I look at AI investment outside of AI, that's fairly muted. I also look at the housing market. That is certainly constrained by interest rates. So I think that does tell us something, but I'm not sure that it tells us the full picture of if policy is currently restrictive, which is, I think, the point of that comment, right, is that's the question that we're all trying to answer, which is how restrictive is policy, or is policy completely in the wrong place right now?
Or is policy doing the same thing that it always has done, or is it acting somewhat differently? And I think that increasingly we're talking about the front end of the yield curve as potentially rising to offset or bring down the long end of the yield curve. That actually, it might be oddly good for equities, good for risk assets if the Fed were to be more proactive, because it might get control over the long end of the yield curve that seems to be going to the highest level since 2007. What do you make of that argument?
I think it's an interesting argument. It does connect back to this idea of if the Fed has credibility right now. And I think that there are a couple ways to look at this. Traditionally, when I look at if the Fed has credibility, I'm looking at inflation expectations. And interestingly, inflation expectations are very benign. Even in this most recent move higher in oil prices, you can barely see it on a chart for 2-year inflation swaps. They're near 2-year lows. And if you go out even further to the 10-year and the 30-year inflation expectations, those have remained very contained, even after Chair Warsh's press conference that some have raised as indicating, some type of loss of credibility. So from that perspective, I'm not necessarily sure that the Fed needs to change anything to regain that credibility. I think one way that this could resolve itself is just seeing the data come out that confirms the idea that the labor market is stable and the underlying sources of inflation associated with demand continue to slow, like what we saw on Friday with the jobs report. Now, there was a lot of noise in the jobs report, but the one thing that wasn't noisy about that report was the signal from wages. That continued deceleration in wages is an indication that, this isn't an economy it's a healthy economy. But it is an economy that's overheating to the extent that the Fed needs to be taking aggressive action.
10 seconds. I've got $25 billion of 30-year notes to sell on Thursday. You buying?
I think that these yields are attractive. And despite the fact that we see a lot of supply, we're seeing a lot of record demand to match that record supply. And I think people forget about the demand side of the equation. We're so focused on those supply numbers.
I think we've got a buyer. Kelsey, Berro,
Yes.
JPMorgan Asset Management. It finally came. Somebody who is interested in this particular maturity. Coming up next, Anastasia Amoroso, Partners Group, Libby Cantrill of Pimco, David Tinsley of Bank of America Institute, and Mark McCormick of BMO. From New York, this is Bloomberg Surveillance. Good morning.
CPI print and inflation prints going forward are really going to be the key.
It's not just an inflation issue, it's an uncertainty issue.
If you get a hot CPI number that comes out, that's going to create some problems.
I really think in times of high inflation, the Fed has one tool, and that's interest rates.
Effectively, the Fed is going to, we think, get bailed out by lower inflation data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to the second hour of Bloomberg Surveillance. Stocks looking to eke out gains ahead of key inflation data tomorrow, with earnings from CoreWeave and Supermicro on deck later today. Big Tech continuing its fundraising binge with a $500 billion funding agreement for NVIDIA, and new share sales from Intel, and bonds pricing back in rate hikes as the price of oil continues to rise. Inflationary pressures once again resuming.
Everywhere you look in this market right now, supply side, demand side, you're seeing those inflationary pressures, whether it's coming from AI and some of the circular financing as well. We were seeing with some of these deals, and just the demand you were seeing in both the equity and debt side when it comes to artificial intelligence, and then of course oil. There seems to be no end in sight, not just for a peace agreement right now, but just to reopen the Strait of Hormuz. And I think a lot of people last week were really comforted by the fact that the talks continued, not with the United States, but with Iran and Oman, two individuals, two countries that can work together to at least start getting some more vessels through. And right now, that's not happening.
So there are a couple of inflationary fronts. On one hand, you've got oil prices rising. On the other hand, there are real questions about the artificial intelligence build out and just how much capital some of these companies are raising. Yesterday was pretty unprecedented. Not only did you have the reports around a $500 billion ambiguous financing plan agreed to with NVIDIA and 6 Wall Street players, but you also had 19 investment-grade issuers in the U.S. market. You also had Intel's share sale. And of course, you have just a pipeline that continues to grow. There is a sense of endless desire for capital at a time where it's an existential threat not to build out enough to be competitive.
Exactly. And I was really struck by Intel, because we were talking about that early in the morning. And then by the end of the day, they raised $20 billion, a third more than it was actually targeting. So you can see that there is oversubscription when it comes to a host of these stories.
And meanwhile, you also have the consumer. We were speaking with the IHG CEO talking about how much people are traveling. Maybe they'll travel to the mountains of Japan to celebrate Mountain Day where markets are closed, or maybe to Europe. A real question about how much that can remain intact even with these inflationary pressures. And right now, we've seen that pretty much come through, at least in the earnings.
Lisa, you nailed it during the airlines earnings. This was an AI trade because people are inking all this money when it comes to artificial intelligence, what they're seeing in the stock market, and the upper K is really just now releasing all that capital into the real economy. And what I heard from the IHG CEO was the same exact thing. People are spending, and even the lower K. And he talked about statistics of more Americans having passports, more people getting out there and travel. There is just more demand for this, and what we're seeing right now, we're seeing across airlines, seeing across hotels.
And there still is demand for equities, with them seeing a bit of a lift in futures throughout the morning, gaining as people take a look at the fundamental earnings, some of the fastest pace of earnings growth going back to 2021. S&P futures up 0.2% now, building throughout the morning. NASDAQ futures up 0.4%. They've got a further way to claw back to those record highs earlier this year. And even Russell 2000 participating up 0.3%. In the bond space, here is the dissonance. On one hand, you've got the rally in stocks. You've got a sell-off, at least at the long end of the yield curve. We're seeing a bit of an inflection for the 2-year yield. We'll take a look at what exactly caused the turnaround, but lower just slightly, 4.24%. On the long end, watch this space. 30-year yields just eking closer to the highest level since 2007, 5.26%. And a lot of this has to do, yes, with some of the big sales of AI-related debt. It also has to do with inflation expectations coming from consecutive shocks, with oil prices inflected higher for a fourth straight day. Coming up this hour, Anastasia Amoroso of Partners Group with stocks seeking direction. Libby Cantrill of Pimco looking ahead to key primary elections. Mark McCormick of BMO as Yentervention gains fade. I will have to get used to saying that. We begin this hour with Stock Steady as investors await fresh earnings and eco data. Anastasia Amoroso of Partners Group writing, "We are constructive on the outlook for markets and the seas of the economy. Corporates, CapEx, consumer are on solid footing. Anastasia joins us now. Anastasia, great to see you. Thank you for being with us.
Good morning. Good to see you.
So let's just start with this expectation of what we're seeing with the issuance of ARI-related debt, and at what point it becomes concerning to you that everyone has their hand out. Everybody wants money, and there are questions about exactly what they're buying and who's going to be successful.
Sure. Well, first of all, let's size this up a little bit. You have the hyperscalers that are trying to build out CapEx to the tune of $1 trillion. That's not going to take only free cash flow. That's also going to take a whole lot of debt. But here's how I would think about it. If you look at the hyperscalers themselves or the data centers, you have seen some credit spread widening. But when you actually look at the interest coverage ratios for the said hyperscalers, they're still in very good shape. So yes, they've taken on incrementally more debt, but actually the coverage ratios are still something like 4 times what the rest of the investment grade bond index is. So for the time being, I would say the bond markets are open, the bond markets are available, and investors are stepping up to actually buy some of that debt. So for the time being, I think we're okay. But I think the really important point, Lisa, is if you kind of, apply the playbook from prior, excessive build outs or prior financial crisis, it's all about the leverage and it's tracking that leverage. So I think as investors, we have to really carefully put pen to paper and start writing those amounts down. Is it through asset-backed finance? Is it through investment grade? Is it through private credit? Is something else? But we have to start tracking those amounts. I would say not a cause for concern today, but this is likely what ultimately will come to hurt us.
A lot of people are looking at this build out as one of the inflationary pressures that has been rising. Also, it is, of course, oil prices. And we have been talking about a 4th consecutive day of oil prices rising. Now, oil prices lower on these headlines that the Pakistan defense minister says that things are shaping up in favor of peace, that the U.S. and Iran are close to some arrangement. And even though you had seen gains in oil prices earlier, now you're seeing them inflect lower. How much does that shape your narrative about inflation going forward, about just how risk on or risk off some of this is going to be?
I mean, quite honestly, not that much anymore, because, the reality that I think investors have come to grips with is that we don't know when the peace deal is going to happen, if it's going to happen, and you have to focus on what fundamentally drives the economy, which is, again, the corporate profitability, which is really banner and stellar this year. It is the consumer that, Lisa, to your point, the reason why we are able to shake off the oil prices is because wage growth is still running at 3.2%, give or take. If core inflation is running at 2.5%, that still gives you that real spending power. And then it's also the AI CapEx, and clearly it's not been deterred by the price of oil. So that's what fundamentally drives the economy. And I think, the other thing we've kind of got accustomed to as investors is there are workarounds, whether there are different pipelines that you can use to try to get that oil outside of the Strait of Hormuz, whether it's oil production that has been picking up elsewhere. I mean, I was just looking at the U.S. natural gas production and oil production. We're near record highs. And by the way, that's not only the case for the United States, but also supply has surprised in other non-OPEC parts of the world. So I think the really big silver lining of the Iran conflict is that we went into it with a lot of buffers, and we've been working those down. But fortunately, we had those in the first place. So I think that's why the markets are able to still maneuver through this.
Can the market, though, at some point shake off this conflict if it continues? Because, sure, very sensitive is the top line oil price. We'll have geopolitical premiums on and off. But you are seeing higher prices down the chain when it comes to jet fuel and gasoline and diesel, et cetera.
Yeah. Look, I think by and large, yes, we can shake off and we can work our way through the conflict, but it does slow growth on the margin. So for example, we were modeling this back at the peak of the conflict. We were anticipate probably 50 basis points, move higher in inflation because of that, and something like 30 to 50 basis points move lower in GDP. Again, we're not talking about full percentage points, but we're talking about the increments. And the reason for that is if you think about oil as a percentage of the CPI basket has been declining over the years, and it's fairly small, 5 or 6%. If you think about the oil intensity of the U.S. economy or global economy has also declined by something like 70% since the 1970s. And so that's what's been really surprising, I would say, is just how oil efficient, whether it's the economy in the U.S. or China, has been able to be. So I do think it's an incremental headwind, but one that we can work our way through. And I guess I should extend this to the Fed also. And, if
you think they can look through it or work around it?
I actually do. I think One of the things we talked about this last time, but Fed Chair Warsh will be looking at is real-time, real-world inflation data. And if you look at the CPI, and if you look at the core services inflation, first of all, core services excluding shelter has been falling, and the 3-month average has declined now close to 2%. Now, if you look at the shelter component, that's the component that is running above 3% in the official numbers. But if you look at something like Zillow and you kind of, proxy that rent inflation with Zillow numbers, you're actually looking at core inflation running at 1.6%. So I think that's going to be a real debate at the Fed. And what is the right inflation metric to actually look at?
Right now, what's your top bet in terms of positioning? How much are you saying it's time to lean into private equity, private debt, public equity? Are you looking at this being more of a risk-on market or a more nuanced kind of play the balance sheet a different kind of way?
Yeah, look, I do still see opportunities in public markets for the 3 C's reasons that I talked about. But at the same time, it is very much tied to the AI trade. And one thing that I do worry about as some of the models get commoditized, the leading frontier models get competition from the open weight models. What does that do along the supply chain? What does that do along the food chain? And I do see the risks building, for example, in the semiconductor space. And so if you kind of tally all that up, that's a lot of public markets that are tied to that AI trade. So I do think risks are building there. On the flip side, if I actually look at private equity, first of all, valuations on the index itself are at a 15-year low relative to public markets. So I like that entry point. And I also think it's sort of the interesting counterpoint to the AI trade, because the true opportunity with AI, in my mind, is what do you do with the models? How do you actually create value within your portfolio companies? And if I think about our portfolio and the initiatives, the AI initiatives that we have across 90% of our companies, they're not solving the shiniest of problems, but they're solving the mundane. They're optimizing, they're streamlining, they're pulling together a whole lot of data. But in the process of doing that, they're driving productivity and they're driving profitability. So I think it's an immense opportunity actually in private equity to apply that AI playbook and drive that value creation. So I would certainly look at private equity and private credit. I think the fears of software death have been, for now, greatly exaggerated. I think the health of private credit is actually better than most think that it is. And spreads are wider and rates are higher. So I like that as well.
Anastasia Amoroso, thank you so much for being with us this morning. Anastasia Amoroso of Partners Group. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. Intel increased the amount it's raising in a share sale to about $20 billion, a third more than it was originally targeting. Sources telling us here at Bloomberg the chipmaker is poised to price the offering at about $95 per share. That would be Intel's first public share sale since it listed in 1971. Riot shares are surging in the pre-market, Anthropic striking a $9.1 billion cloud deal with the Bitcoin miner. Sources telling us here at Bloomberg that Anthropic is buying compute capacity from Riot's Rockdale, Texas campus, adding power as AI demand grows. President Trump defending embattled FIFA President Gianni Infantino amid a growing revolt that threatens Infantino's leadership. In a Truth Social post, Trump writing, quote, FIFA would be making a terrible mistake if for any reason they even considered replacing President Gianni Infantino. And that is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. I'm not sure if President Trump is helping or hurting Infantino and his chances, at least his reputation with the Europeans.
I think some of the damage is done already, regardless of what the President of the United States says.
Well, we will, of course, be following this, as I'm sure everyone is. Up next, progressive momentum in focus.
These are people that have been not successful. They have nothing going, and they're telling us how to run our country. And I just don't think it's going to happen. Now, I may be wrong.
Libby Cantrill of Pimco, watching it all, joins us next. This is Bloomberg Surveillance. Good morning. Stock's getting a new boost after those headlines talking about some possibility of peace in the Middle East. A real question here about how much people end up buying into these headlines every time they come out. Pakistan's defense minister was speaking to reporters in Islamabad and said things are shaping up in favor of peace. and that the U.S. and Iran are close to some arrangement. As a result, S&P futures getting some life, up 0.2%. You see a bit of a question about crude, now actually inflecting lower, 0.4% decline. 10-year yields now unchanged after having been 4.73%, now 4.71%. The dollar versus the Japanese yen, really interesting in light of the yen intervention last week. Yes, I'm going to keep saying that. 159. We'll be talking about that more this morning. But really a question about how all of these factors play into the November midterm elections. Under surveillance this morning, progressive momentum in focus.
When you look at the radicalism and the craziness of the candidates and the stupidity of what they're suggesting, these are people that have been not successful. They're people that have been, in many cases, failures. They have nothing going, and they're telling us how to run our country. And I just don't think it's going to happen. Now, I may be wrong.
Here's the latest primary elections taking place in 6 U.S. states today. The face-off between moderate and progressive Democratic candidates continuing ahead of the closely contested midterms this November. Bloomberg's Tyler Kendall joins us now. Tyler, yes, we have to focus on this, even though some people are saying we still are in August. We can wait. It seems like the battle on the left is as strong as the battle on the right.
Lisa, that's a really good point. And tonight's election results will give us some insights into how both parties are going to connect with voters as we get closer to November. We're watching very closely this Democratic primary for Wisconsin's gubernatorial race and whether or not this shows momentum for Democratic socialists is either stalling or boosted. The candidate there is Francesca Hong, though she has failed to secure the endorsement of prominent progressives in the party like Senator Bernie Sanders amid reported concerns about her viability as a candidate in the general election. We're also seeing progressive versus moderate candidates play out in the Democratic primary for the open U.S. Senate seat in Minnesota, further shedding light on this conversation, because while there are concerns about the viability and electability of a more progressive platform, Republicans are, of course, as you mentioned, facing headwinds of their own. For the first time reportedly since 2010, a Fox News poll finds voters feel Democrats will handle the economy better than Republicans, leading by as much as 9 percentage points in a survey released last month. Lisa, one other race for your radar. I have my eye on the special election to fill the Senate seat left by the late Senator Lindsey Graham. His sister, Senator Darlene Graham, is vying for the spot. She's backed by President Trump, but there's questions about whether she can emerge from what is a very crowded primary.
Tyler Kendall, thank you so much for being with us. Tyler, going over all of the potential elections and election results later today. Libby Cantrill of Pimco writing, our base case for the November midterm elections continues to be a split Congress. Regardless of the outcome, neither party is likely to have a real governing majority come 2027. Yay, more gridlock. Libby joins us now. It seems like markets like that, so maybe that is a positive.
They do like it.
So what are you expecting in terms of gleaning insight for the fight for the Democratic soul and parties' sort of direction going forward?
Yeah, well, we're seeing, I think, a lot of interesting trends almost converging. It's this really sort of anti-incumbent, anti-establishment sentiment that's been playing out across both parties, both Republicans and Democrats. And then, of course, within the Democratic Party, this is also being kind of woven into this, Democratic socialist, this sort of far left ideology versus the more kind of mainstream establishment Democrats. It really hasn't actually had major implications for what the midterm election results have been so far, at least before last week, in that many of these fights are being played out in kind of blue, if not very sapphire blue districts, New York City, Denver, Colorado. Whether the Democrats going to be liberal or very liberal, it doesn't really matter in terms of sort of their electability in those districts because they're sort of overwhelmingly Democratic. However, last week it really changed in terms of the Michigan Senate race, and now you have the Wisconsin gubernatorial race and also the potential, Minnesota Senate race as well today. So in terms of the primary, so I think that this has been sort of an intra kind of family spat that has really had few implications for the midterms. However, again, last week has changed that. And again, I do think that it probably puts this Michigan Senate seat, maybe Minnesota, depending on how that turns out today. And then, of course, the Wisconsin gubernatorial seat, which is going to be important for the certification of the election in terms of 2028. This is going to have implications for not only the midterms, but potentially for 2028.
This family fight within the Democratic Party that's going to play out now in the midterms, we saw it happen last week. How much is that going to set the tone for 2028 and the candidate that they end up choosing?
Yeah, and I think this is going to be, obviously what happens, today will be interesting, particularly in Wisconsin and Minnesota. But I think what is going to be more important is obviously what happens in November. And so these people can, their rhetoric is obviously resonating with a group of the Democratic Party, but can they then pivot and have a more sort of centrist message that then can actually make them electable for a general election come 2026? If these folks lose, if El Sayed loses in terms of November, if Francesca Hong wins today and then loses in November in terms of the gubernatorial race in Wisconsin, I do think that's going to sort of take some wind out of the progressive left sails going into the general election in 2028. If, however, they win, then you're going to really see this fight, I think, really play out in terms of the primary.
Big picture, what kind of numbers are you looking at for after the midterms in terms of the composition of Washington?
Yeah, I mean, honestly, even if this is a wave election for Democrats, and there are some inklings of that in terms of the generic ballot, in terms of the enthusiasm gap, Democrats are much more enthusiastic about voting this election. Those are sort of two indicators that we are monitoring that have sort of suggested wave environments before. In terms of the House, there's a much lower ceiling for how many seats Democrats can win because of the redistricting that has happened. So honestly, a great night for them would be a kind of a +10 majority, +15 majority. We're not talking about the sort of +40 majority that we have seen in other sort of midterm elections. And that is just, even if that comes to pass, and I think more likely is that Democrats, have a 5-seat majority in the House. And then maybe Republicans have a 50-50 Senate. I mean, that is like neither party is going to have a governing majority. I mean, I think in maybe sort of this quixotic world, you could say those are the ingredients for actually compromise. If President Trump wanted to do something, say, on immigration, for instance, or maybe on health care, those sort of narrow majorities, sort of split Congress have given way to some compromise in different political environments. I don't think we should fool ourselves. I think this means more gridlock. It means that, I think we've seen kind of past peak President Trump. I think there's going to be obviously much more oversight and what have you on him. But in terms of stuff that's getting done, it's going to be very, very minor.
Is gridlock still good when people can't even be in the same room together and talk? I mean, it's one thing to have Democrats and Republicans, say, 10 or 15 years ago when people would have, salons together and they would go out together. Now, when you go to Washington, D.C., it's very different. People don't talk to one another. They don't congregate together. Is gridlock still as good for markets as it used to be?
Yeah, I think that's a great question. And I think that sort of when the rubber meets the road for markets is when they really need Congress and they really need the fiscal authorities to do something, right? And we did see, of course, during COVID that a lot of this partisanship fell by the wayside and they were able to spend a lot of money, which is much easier. The harder task, obviously, for Congress is to do the really hard things politically, which, of course, we've talked about in terms of reducing the deficit, something that
wow.
An audible laugh by Annmarie. But honestly, I think it's warranted. I mean, it's just in terms of actually doing the really hard work, whether it's going to be raising revenues, raising taxes, difficult to do, obviously, reforming Social Security, reforming healthcare. Those things we all know are coming. Honestly, they have to in terms of our fiscal picture. Now, whether it's going to be in the next 3 years, probably not. But, that 2031 Social Security Trust Fund inflection point, I do think that's going to be a forcing mechanism. And that will be sort of when the rubber meets the road. And I think the markets will be focusing more on this kind of, dysfunction in Congress.
Just 30 seconds. How much do higher interest rates really challenge this that much more, given how much more the interest expense is right now for the U.S.
I think, mortgage rates have obviously are much higher than they were. Not their highest, obviously not during, what we saw during the Biden administration. Gas, though, I have to say, gas is still the thing. It's gas and groceries, housing, sort of healthcare, sure. But gas, the price of gas really does get into the zeitgeist of voters. And so with that above $4, a gallon, I do think that's going to be a headwind for the president and the president's party.
Libby Cantrill, thank you so much for being with us. Libby Cantrill of Pimco talking about why we all will be focused on the deficit in the next couple of months. That's not at all what she said, but I do think about
couple years.
At what point? I mean, yeah, exactly. I mean, you think about it and you take a look at the trajectory of interest expense, and if 10-year yields and 30-year yields stay where they are, suddenly we're looking at $1.6 trillion to $2 trillion. I mean, this starts to get pretty serious.
Yeah, it is pretty serious, and we have passed that moment where, we're paying more on our net interest than we are, as you mentioned yesterday, than our defense budget. This is a huge problem, but the bond market, the markets in general, are going to be the driving force on that. They're going to be the ones that force Congress to act. in 5 years' time, maybe, hopefully.
Yeah. I'm imagining people rolling their eyes listening to this saying, of course you turn that into a bond market conversation. Coming up, David Tinsley of the Bank of America Institute with a check on the consumer. The mood music in the Middle East is more positive. So you're seeing a bit of a gain in equities. They had been flat on the day. Now they're up about 0.2%, although fading a little bit, now up only 0.1% on the day, following reports about potentially some sort of peace agreement coming from the Pakistani foreign minister. The dollar, this to me is the place to watch. Do we get some more yen intervention? Again, I'm going to say this phrase, given the fact that it is pretty slow right now over in Japan, and given the fact we've retraced more than half of the yen intervention that we saw last week, 159.18 this morning. 10-year yields now back up 4.71%, and crude prices also just up 0.3%. A real question here about how much these headlines actually move the dial, Annmarie. I mean, ultimately, we're sort of sick of this whipsaw. At the same time, markets seem to always respond.
I don't want to be too critical, but the Pakistanis are a mediator, but they're not involved at this critical moment between Iran and Oman. And it sounds like this defense minister is just trying to wish cast and manifest some peace agreement. Not even the Oman-Iran Strait of Hormuz opening, but the United States and Iran, which we've been here for months, and the president says we're low-keying it right now. It's just kind of shocking to me how vulnerable still the geopolitical risk premium whipsaws very quickly on the oil price.
Yeah, well, wish casting might be better than not wish casting. 2 hours away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with the latest earnings we've gotten this morning, and they are from On. Shares are plunging nearly 17% in the pre-market after the company slightly lowered its growth outlook. And part of what's happening here is a tug of war between On and the retailers selling its shoes. The U.S. sneaker market is heavily promotional right now, but On wants to stay premium. So ahead of new product launches, it's been limiting the amount of older versions of its shoes that it ships to retailers. And while that helps avoid discounting, it means fewer shoes going into stores, and that weighed on sales this quarter, and it looks like it's going to affect the company in the near term. Meanwhile, we are seeing Rocket Lab shares under pressure as well, down 5% after the smaller SpaceX rival warned that its most important new rocket will face delays. Neutron is expected to go head-to-head with SpaceX's Falcon 9, but Rocket Lab is no longer committing to a launch this year. And adding to the disappointment, the company did post a wider loss than Wall Street expected. And we end on Riot. This is one of those big Bitcoin miners that has transformed itself into an AI data center company, and it just landed a huge customer in Anthropic. It has signed on for a $9.1 billion deal to use its capacity at one of its campuses in Texas for 20 years. That is a long commitment, and of course, having a major player like Anthropic in the AI space signing on gives major credibility to this company, so shares are soaring more than 16%. Lisa.
Thank you so much, Yahaira. On our radar this morning, a new comment raising hopes for talks between the United States and Iran. The Pakistan defense minister telling reporters the U.S. and Iran are close to some arrangements, and things are shaping up in favor of peace. Stocks higher on the wake of those headlines, as well as oil prices after initially fading. OpenAI buying back roughly $7 billion worth of shares from employees ahead of its potential initial public offering. Sources telling us here at Bloomberg the deal values the ChatGPT maker at $852 billion. And Anthropic meeting with potential investors to address concerns ahead of a possible IPO. The Wall Street Journal reporting investors are pushing executives for details on cheaper alternatives in China, data center backlash, and financial stability, even as they make new deals with potential partners for additional compute.
Right. They want the additional compute, so they're going out and making those deals. At the same time, investors want to know how tangible is Anthropic going to be in the future when you have the threat of some of these much cheaper Chinese models. And according to the Wall Street Journal, the executives are surprise, surprise, downplaying the Chinese competition in meetings, telling investors Anthropic is hyper-focused on offering cutting-edge AI models. But obviously, this is what the whole debate and concern is in financial markets. You can see those jitters, as well as the national security sphere, about actually how much potentially can China not just catch up, but create these cheaper models that maybe even at some point surpass the United States.
Yeah, and a concern that the rolling ball of cash is moving now away from some of the LLM, the large language models that are on the frontiers to the hyperscalers. A question also of who's going to pay for it all, which really comes down to the consumer. The Bank of America Institute Consumer Checkpoint report highlighting a resilient consumer, noting a slight slowdown in a pace of total card spending, writing the consumer is converging and K is closing. For the first time since 2024, lower income wage growth exceeded higher income household wage growth. Also going on to say that really you've seen the fastest pace of wage growth for the lower income cohort going back to March of 2023. David Tinsley of the Bank of America Institute joins us now. David, what do you make of this convergence in particular and the fact that the lower end of the K seems to be catching up?
Yeah, thanks for having me on. Well, I think this is good news. If there was a convergence where the high end was coming down, say, then, that would raise questions about the overall pace of consumer spending. But what we see in our data, which covers July today, is that this remarkable, really, convergence in the K. A couple of months ago, I was on your show. We had a big gap. And there seemed no end in sight to it, in all honesty. And now, as of today, in our data, that gap has closed. If anything, lower income households doing slightly better now than the highest income cohort, both in terms of spending and wage growth.
Where is it coming from, David? Is it a particular type of job mix that's leading to this pickup in wages for certain spheres of professionals, or is it just that the economy truly is broadening out with respect to the momentum?
Well, I think it's a couple of things. One, on the labour market side, notwithstanding the weakness we saw in the latest data, we saw some better figures earlier in the year. And the lower income consumer is more sensitive to those job gains because they spend all they earn, essentially, as opposed to higher income that are more kind of dominated by wealth effects. But there's one other thing, which is more of a technical thing, really, in our data, is that it's an after-tax measure. And we think some lower and middle income households have also been reducing their tax withholdings this year, which in a sense is another manifestation of the stimulus from the One Big Beautiful Bill Act. So relative to pre-tax wages, after-tax wages are strengthening. So it's a kind of bit of both, I think, most likely.
There's also an issue of how much this kind of flies in the face of discussions that consumers were eating into their savings in order to support some of their spending. How much is this sort of a repudiation of that, the idea that maybe it's reversing and people are just spending more because they're earning more?
Well, in our data today, what's quite surprising, really, is that wages and spending are pretty much in balance, particularly for the lower-income consumer. Funnily enough, for the high-income consumer, their spending is outstripping their wage growth, but they do have the kind of benefit of the wealth effects. So we aren't really seeing a consumer that's wildly out of balance. And then when you look at our savings and deposits data, there's been some drawdown from those tax refunds. But it's no different, really, to that we saw last year or previous years. So we're not seeing anything on the deposit side or even on things like card metrics, like the share of people making only the minimum payment on their balance. That looks fairly benign, too. So I think the consumer health picture is pretty benign, really.
I know you did some research as well about the gig economy. Do you see more individuals on the lower end of the spectrum having to work multiple jobs to make ends meet?
Yeah, we do see a bit of that, actually. It's quite interesting, that gig data. So when you look at the share of people who have a regular paycheck coming in but also work gig, we see that share rising up about 0.5% year over year. So not dramatic increases, but some increases. And I think you're right. I mean, that could be for a host of reasons, including, the ease of doing that with technology. But I think one reason could also be that people at the margin need to supplement their core pay because some people clearly are feeling under pressure from gas prices, utility bills, etc.
David, that brings me to my next point. I wanted to get some information from you. How much do you see individuals having to put aside more money for everyday costs like gasoline and electricity?
So in our data, interestingly, spending on gasoline actually declined a little bit in July. And that's really because of this, as you were saying earlier in the show, this constant whipsawing in the oil price and the knock-on to gasoline prices is very volatile. So it adds quite a lot of uncertainty for consumers. And where we are now, of course, is that they've been creeping back up again. You have to keep that, I think, in perspective. I mean, the average household spends maybe a couple of $100 at most on gasoline. So they spend far more on other discretionary items. The tax refunds were far more than that. So it's not to say it doesn't matter for some consumers. But I do think gas is an easy thing to focus on. There's a big sticker price on the gas station. Everybody knows when it goes up. But as a percentage of budgets, it's not that great.
David, is this survey typically a leading indicator or a lagging indicator?
Well, I'd like to think of our card data as pretty contemporaneous in that we're looking at the card spending data of upwards of 70 million consumer and small business accounts. So it's kind of like a real-time pulse, really. Now, the financial health metrics, I think they may speak to the future somewhat. So if you do get a shock, you do get a slowdown in the labour market, etc., how are consumers faced? How can they cope with that? And the financial health measures looking sound, I think, is encouraging.
David Tinsley of the Bank of America Institute, thank you so much for being with us. As always, on the survey, some bright spots really standing out to me, the idea that you saw the fastest pace of wage growth at the lower end of the income sphere going back to March of 2023.
And the K is closing. Those are the words David used. I mean, that is a massive bright spot. At the same time, there are individuals that are having to actually pick up extra gig work just to make ends meet. So there's, some positive indicators here, but also some notable issues on the sideline.
Quality of life issues in particular. Yeah. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. Mark Zuckerberg published a 6,500-word essay on AI, emphasizing his belief that wider access to models is key to the industry's future. Zuckerberg says he supports open source AI and challenges the notion that concentration of power in a few companies can ensure safety. Apple is still planning to offer an all-glass iPhone for the device's 20th anniversary. Sources telling us here at Bloomberg the report by a Jefferies analyst that the model was cancelled is untrue. Apple expects to launch iPhone Pro models next year. President Donald Trump issuing an executive order recommending the measles, mumps and rubella vaccine be broken into 3 separate shots. Trump connecting the issue of vaccines to rising rates of autism. The American Academy of Pediatrics says the order will likely result in at-risk kids missing or delaying useful vaccinations. That is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, fading intervention highs.
There's an awful lot going on in Japan. The market needs more reassurances on supply of JGBs, along with a faster pace of interest rate hikes.
Mark McCormick of BMO joins next. This is Bloomberg Surveillance. Good morning. Still sticking with a positive tone after some constructive headlines coming up from the Middle East, although fading from earlier highs. Right now, in the equity space, you can see the S&P futures still up about 0.2%. The NASDAQ futures gaining about twice that, up 0.3%. And the Russell 2000 even getting in on that, up 0.2%. Really a question of what some of the softening in rhetoric, at least for the past 30 minutes, means for the bond space, for the Federal Reserve. Right now, 2s, 10s, and 30s. You are seeing a bit of a decline at the the front of the yield curve, 4.23%. Yields a little bit lower. 10-year yields unchanged after earlier being higher by a basis point, almost 2 basis points, 4.7%. And that 30-year still not catching a break, 5.26% ahead of that $25 billion auction of 30-year notes coming on Thursday. In the oil space, this has been sort of all over the place this morning. At first, it was up for a fourth consecutive day. Now it's essentially unchanged after headlines that Annmarie thinks are just noise, given the fact that we hear this all the time. At the same time, it does give you a sense that people are susceptible to what we hear out of the Middle East.
Oh, absolutely. And this is coming from the Pakistanis, which have been key mediators. But at the same time, how many times have we heard this? And also, it isn't something emphatic from the White House or Tehran. It's the Pakistani defense minister basically saying things are shaping up in favor of peace. Okay, that doesn't sound so concrete to me.
Well, and that's the reason why we haven't seen that huge of a move there. At the same time, watch this space with respect to the dollar versus the yen. Last week, we saw the U.S. and Japan get together for the first bilateral intervention in the currency going back decades. Now we're looking at a retracement from some of the strength in the Japanese yen last week, coming back, taking out more than half of that, raising a question about whether there could be further intervention. Under surveillance this morning, fading intervention highs.
There's an awful lot going on in Japan. The market needs more reassurances on supply of JGBs, along with a faster pace of interest rate hikes. There are noises. We have had a number of reassurances from the government about supply of JGBs, but the market isn't hearing that.
Here's the latest. Traders preparing for the possibility of another intervention for the Japanese yen, the currency wiping out nearly half of the gains delivered by joint action from the U.S. and Japan nearly 2 weeks ago. Mark McCormick of BMO writing, while markets see it as a joint effort to stem the Japanese yen rout, it is more likely about U.S. rates and liquidity. A durable recovery still looks some way off. Mark joins us now for more. Happy Mountain Day. Mark, thank you for being with us. I do want to know how much you do expect further intervention by the U.S. with Japan as a result of what's going on in the 30-year yield.
I think this is largely a one-off. I think what they're trying to do is they can't change the market trends. We know the fundamentals are very bearish for Japan, but they're bearish because the Japanese are selling yen. The GPIF, the pension funds, even the corporates. The corporates are building up large profit margins and they're exporting that capital out of Japan, most likely back into the U.S. AI tech cycle. So I think a big part of this is the Japanese want to stem the weakness in the yen, but at the same time, the BOJ is dragging its feet, and capital flows and capital allocation set by the GPIF and the pension funds just keep reinforcing the weakness in the yen. So I think on the U.S. side, what they're trying to do is keep yields from going up. They don't want the 10-year yield, the 20-year, 30-year yield going up. So you could see they even nudge the use of FEMA, which is essentially say, let's use treasuries as collateral. We'll give you a repo. Here's your dollars. Go buy your yen. So essentially, these transactions are happening without treasuries or without reserves moving, which clearly indicates we don't want to see yields moving higher.
Which means that it might not necessarily be that much of a difference for them if the yen actually loses some of the strength from last week, because it's actually irrelevant as long as Japan isn't going to be selling treasuries. Why didn't the meeting minutes from the Bank of Japan's last meeting make any difference, even though they indicated they potentially would be ready to hike rates sooner?
It doesn't really matter if they hike rates sooner. They got to go way faster. They also have to point out to the degree that where their neutral rate is, which is probably closer to 2.5% to 3%, they haven't even made these suggestions yet. So the fact that we might nudge it a little bit faster, they're a couple years already behind. So they can't be going twice a year. They probably need to be going 4 times a year. So I think the markets kind of recognize the fact that, like, the BOJ is kind of using rhetoric, it's using language, it's trying to get ahead of the curve in terms of maybe saying that it's going to do the right things, but it's not doing any of it. So it's like they've got to go hard, they've got to go fast if they really want to change the trajectory in the yen.
If they aren't willing to do that, which so far they haven't seemed willing to do that, then what's to stop them from, even though they didn't sell treasuries to support their currency last week, doing that again in the future if there isn't an unlimited pool of money coming from the Fed's facility to help repo some of these purchases in the meantime?
Well, what they could do, again, you could see it. What came in the headlines before this is they're trying to nudge the pension funds. They talked about repatriation, the amount of money that's been pushed abroad. The problem is the GPIF does a coordination. They discuss things every 5 years, and they come up with their policy and their benchmark weights for asset allocation. They just did this in 2025. So they are not going to change their asset allocation model. And we understand, like, the way that pension funds work is it's governance. It's for the people on the other side of the pension fund. It's not there for a political means related to the currency. So at the end of the day, they've already done this review. The next review is in 2030. So maybe they've set, it's a total portfolio type approach. They can change their bands a little bit. They could trade a little bit. That allows more yen to come on shore. But the capital allocations they've set are already bearish for the yen. So there's a lot of the corporates need to change what they do with their profits. The pension funds need to do what they change with their capital flows. And the BOJ needs to change its policy. And none of those things are moving fast enough in the right direction. So this is...
So basically, we see a yen continuously to be weak until 2030?
I think over at least the next year, I would not be surprised. Again, we pushed back on the 160 was the level. We said we've been targeting 165. We got up to 164. I would argue there's even sentiment in Tokyo. We met clients there a couple weeks ago when we were in Asia. There's discussions around 170. And I think what was very clear is the market was really nervous that the Fed was going to hike in July. The BOJ was going to do nothing. We're going to burn through 165. Markets like big round numbers. So once we go through 165, everyone's like, oh, 170 is coming. So I think the intervention really kind of cascaded around that because I feel like locally, the sentiment is like, yeah, I think we can get to 170. And I think, yeah, that's where could go.
What's your reaction or take, given the fact that the United States did this by using the euros?
It tells you a lot that this is not about FX. It's not, they don't have a dollar policy. I actually think if you keep reading the tea leaves, the memorandum of understanding with Iran, there was a point in there that it's like, you're going to use dollars. If you think about stable coins, again, it's more introduction of US dollars, FEMA, dollar liquidity. So I think the part of it is, I think the preference is to have a stronger dollar and to have the dollar work within the system because all financial assets are still connected to the dollar. So I think the implicit thing is they want to keep the dollar, they want to keep that store of value, but at the same time, they just want to limit how much treasuries could sell off because mortgage rates are going up, housing is turning over. These things are starting to bite.
We have seen the dollar lose some over the past, say, a year, just based on some of the strength that you're seeing elsewhere and concerns about fiscal policy, among other issues in the United States. To what degree do you expect the dollar to strengthen further in a sort of broad-based way versus sort of stay around here because of some of these other crosswinds?
I think the point is we've got the turning point right. At BMO, we were very bullish the dollar to start the year when everyone else was bearish. I heard the same stories I heard last year, which was pension funds are going to diversify, hedging ratios are going to move. The uncertainty that Trump creates is bad for the dollar. I think markets are missing the context. The regime matters. We're in a high inflation regime, flat yield curves. Global growth is still, there's a lot of dispersion. And the U.S. is still the only game in town. All of our macroeconomic signals are very bullish on the U.S. economy relative to other countries. So in that light, I think the dollar's still got a couple more months. Like what we had anticipated was Q1, Q2, Q3, dollar strength. Euro hitting about 112, 111, dollar yen 165. But a lot on the edges of that, the carry trade. So Latin America does well up until the elections. So yeah, I think the dollar's still got some room to go.
Mark McCormick, great to see you. Thank you so much for being with us. Mark McCormick of BMO, and Annmarie is very excited that potentially you could get more dollar strength and more euro weakness ahead of any potential vacation plans.
And also maybe a weaker Japanese yen until 2030. Because, then that's years of potentially, going to see the cherry blossoms, et cetera, having sushi and all the likes.
Yeah, well, it is an issue, though, that somehow the fiscal overhang in Japan is that much more of a serious issue than in the United States. And it clearly is because of the debt to GDP ratio. But again, it goes to the issue that if they can't solve that, they can't really do window dressing with some of this intervention.
It's not going to work. Even it doesn't matter how many times you tap this intervention. It's not going to work until you fix the crux of the problem. And when you hear from Mark, it doesn't sound like that's going to happen anytime soon. This is going to be years in the making.
And that's why Scott Besson is focused on mitigating any potential treasury sales that come along with that mitigation plan. Coming up in the next hour, Charles Schwab Asset Management CEO Omar Aguilar, Isabelle Freidheim of Athena Capital, Sophia Kearney-Lederman of FHN Financial, and Kristen of Citigroup. From New York, this is Bloomberg Surveillance. Good morning.
levering in and going full bore on the bubble is often an imprudent move. I think you want to be careful with leverage here.
We just have these extreme moves in fundamentals, extreme moves in stocks, and that's creating volatility.
There is definitely a question on the sustainability.
We think the market ends higher at the end of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to the third hour of Bloomberg Surveillance. Stocks rising as we look ahead to CPI tomorrow and a slew of Treasury and corporate debt sales. The AI financing cycle only accelerating with companies from NVIDIA to Intel finding different ways to lock in new capital. And meanwhile, inflation worry is still regaining steam with oil prices in focus. They had been higher for a fourth straight day, then lower on some news coming from Pakistan about how talks actually do seem to be progressing with the U.S. and Iran.
Pakistan is a key mediator. I guess I just have some concern because we've seen headlines like this tons of times, and then none of them has ever actually stuck. So Pakistan is saying that the defense minister is saying that the signals in the quote last 2-3 days are that we are close to some sort of arrangement. And then when asked about an update on the U.S.-Iran deal, he had said that things are shaping up in favor of peace. So my question is, when it comes to some sort of arrangement, is this arrangement to reopen the Strait of Hormuz, which you know Iran is talking to Oman about, or is this an arrangement of potentially getting the U.S. negotiators back at the table with the Iranians? I just have a ton of questions about this, but you can see how vulnerable oil is to any geopolitical risk premium based off of any of these headlines coming out of the Middle East.
And you have to imagine, and just to be fair, and it's understandable why somebody would want to shrug this off and say, okay, we've heard this before, what else is new? And nonetheless, the stakes are that much higher given the fact that the Strategic Petroleum Reserve levels are at the lowest going back some 40 years, and a time when people are worried about inflationary pressures coming from gas ahead of CPI tomorrow, ahead of PPI on Thursday. This clearly is at the forefront, even if it is exhausting to follow these headlines.
Right. And as we've talked about a lot on this program, it's not just the Strait of Hormuz. It's what's going on in terms of the Houthis going after refineries in Saudi Arabia. It's what's going on in Russia in terms of the war with Ukraine, in the Caspian Sea, in the Black Sea. Also, China has put a lid on all of these prices. What happens if China decides to change course and starts importing more? You know, recently, The Economist had a piece that said it is no longer OPEC. China is the new OPEC.
And despite all of this turmoil, you are seeing the capital markets wide open for AI-related sales. We saw the arrangement that was reported yesterday with NVIDIA and 6 Wall Street firms about potentially having a $500 billion financing facility. You had Intel selling shares this morning. IBM and Together AI are signing a multi-year pact. You heard about NVIDIA and Anthropic selling new deals for compute. All of this coming at a time where equities are continuing to rise. S&P futures higher by 0.2%. NASDAQ up 0.3%. So still building on gains, potentially climbing back to all-time highs today. You are seeing in the bond space some fluctuations throughout the morning tied to oil prices. 2s, 10s, and 30s. 2s and 10s seeing a bid on the heels of more constructive language coming out of the Middle East. 10-year 4.7%. That 2-year pinned around 4.23%. The 30-year, though, having a harder time finding buyers. 5.25%, possibly more tied to the capital markets side. And in oil, you are seeing earlier today, oil prices had been higher, then they're lower. Now they don't know what to do with Brent and WTI essentially fluctuating between gains and losses. Coming up this hour, Schwab Asset Management CEO Omar Aguilar as markets face a massive influx of tech funding. Sophia Kearney-Lederman of FHN Financial on the upside risks to inflation, and Kristen of Citi on the opportunities unlocked by soaring AI demand. We begin this hour with stocks inflecting higher ahead of fresh tech earnings and economic data. Omar Aguilar of Schwab writing, despite near-term volatility, the outlook for equities remains constructive. We expect some valuation-based recalibration of leadership. Omar joins us now for more. Omar, always wonderful to catch up with you. Thank you for being with us. I want to start on this incredible glut of financing that needs to get done. We see the announcements coming day after day. We're already at a record pace, far outstripping what we saw with respect to 2020 and the pandemic era financing. At what point do you expect to see some more indigestion?
Yes, good morning. It's an interesting, concept of just how this ecosystem continues to evolve within respect to AI. I think the results so far, suggest that this financing and these investment and the CapEx cycle will continue. We have seen, the largest CapEx cycle we have seen in history, especially when it comes down to the AI-related topics. So far in the second quarter, the earnings suggest that a lot of the EPS growth, it is related to AI. So somehow, the investors are starting to see a little bit of their return on their investments. And therefore, for companies, it is natural to continue to expand on that CapEx cycle. Now, to your point, I think, the combination of private credit and just regular public, it's sort of at some point is going to run its course, and at some point it's going to have. So far, it hasn't been that big of a problem, but I think at some point we're going to see some big, losers and some winners, and that's where we're going to see a little bit more differentiation. We're still early because we still need to figure out where these will go and how these return on investments will actually play out down the road.
How much are some of the ambitions starting to be constrained by what we're seeing at the long end of the yield curve? And we were just talking about how we're just basis points or less than that away from the highest levels in the 30-year going back to 2007 this morning.
Yeah, well, we've seen the effects of that long term, tend to be driven either by, economic growth, tend to be the volatility surrounded by potential, challenges of what the debt may be, and also inflation. But in this particular case, it sounds that inflation is less of an issue for that long term of the curve, and it's really more, volatility surrounding, how much of the growth will basically come from these either investments or continuation of economic growth. And I think that uncertainty about how much is economic growth relative to how much is just term premium, it is what is keeping that sort of long end of the curve a little more volatile.
How important then is Thursday going to be for you in terms of looking at the appetite there is for 30-year bonds?
Well, the big part of the CPI reports and the PPI reports and inflation reports is really going to be more about the postures that we will have related to what the Fed reaction might be. So far, the bond market seems to be helping the Fed with their decisions. We saw the labor market giving them enough breathing room last week so that they can actually take a little more time to make the next decisions. But as we see the changes and as we're going to see the impact on that long term of the curve, we'll probably determine what the potential decisions may be in September and even in December. So far, it's 50-50 for what it may do in September, still biased more hawkish towards December. But I think a lot of the results of the CPI and PPI numbers will be just more, trying to tilt, the balance towards whether or not the Fed will make a move, before the end of the year.
So you think potentially this doesn't happen until before the end of the year. But we did hear from the Cleveland Fed president yesterday, Beth Hammack, who, she dissented. She says, I think now is the time to act. She wants to get ahead of it. She compared it to a car coming up on a stop sign, a slow stop instead of slamming on the brakes. Do you see potentially the Fed or Kevin Warsh being forced potentially because there's going to be more individuals who think like her?
Yeah, I think that obviously the dissent is a new thing for the Fed, and these new Fed, it clearly is going to navigate a lot of the discussions that may happen with the central banks. But still, their mandates are very clear, and I think the data needs to support the decision process. And the Fed has a long track record of being very objective and being clear about how these will go. And I think for us at the moment, we still believe that the data may not support an immediate rate hike, in September. The odds for potentially doing it in December are still, up in the air. But, when you look at the labor market, when you look at even just the trajectory of inflation and the drivers of inflation may not necessarily justify, a rate hike at this moment that could potentially, create more problems than solve them.
Could you foresee, Omar, a broadening out that allows the rest of the economy, aside from some of the AI drivers, to continue gaining and actually outperform, but the overall index to kind of remain range bound or kind of not gain all that much from here?
Well, I think this year has been very healthy to see that it's not just the Max 7 and the hyperscalers that are driving the market. But we're starting to just, go back to the earlier part of the conversation that, a lot of the economy and a lot of the companies are starting this AI adoption cycle. And this AI adoption cycle will translate into many things. Productivity gains will potentially translate into expansion of margins. When you see the potential lower costs that they adopt more AI tools for their efficiencies, that could, still at the early innings. And we still potentially see this expansion of their multiples just as a result of just the AI adoption. So we do see, the possibility, going into the rest of the year and into next year that this market will continue to broaden. If you actually think about it, even just when the periods where the AI related stocks were under pressure, the markets still were doing well, which means, there is a significant level of just contribution from other parts of the market, not just A-related, companies.
Omar, you're a fabulous person to talk to for a lot of reasons. Your deep insight into markets, also the cross-section between investors and individual investors and markets. And I would love your take on just what the sentiment is and how much it's shifted around the broadening out of AI and the use of it. Initially, people were worried about the labor market. Has that changed over time and seeing it more as a positive that's driving efficiency gains throughout the broader economy?
Well, we see it in twofold. On one hand, we see it consumer-wise. I think what we see is the general consumption of AI-related products continues to grow. If you think about just, whether it's school systems, whether it's companies, whether it's, just in general, the general consumption of AI-related activities continues to grow and is going to be a big driver of this. It's almost, way back when people started to use internet and, slowly we're building up different things. I think the AI-related consumption, continues to be a driver and will continue to be a driver. On the other hand, we see it on the investment side. Investors, particularly Schwab investors, became incredibly bullish just going from the first quarter into the second quarter. We normally track the level of attractiveness. We ask questions about, what kind of exposure they want to have to equities. And they moved from 28% to over almost 47% from the first quarter to the second quarter. What that means is that investors became incredibly excited about the possibility of these AI-related market to continue going into the second half of the year. There's still obviously reservation. There's concerns about inflation. There's concerns about the war. But, overall, the sentiment continues to be incredibly bullish.
Omar Aguilar, thank you so much for being with us, the Schwab Asset Management Chief Executive Officer. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Oil are racing earlier gains on reports from Pakistan that the U.S. and Iran are, quote, close to some arrangement. The report coming after President Donald Trump laid out new terms for Iran, demanding reparations from Iran over past attacks, as well as compensation to the families of protesters who've been killed over the years. On holding tumbling in the pre-market, the Swiss shoemaker posting disappointing second quarter sales and giving a cautious outlook. The company holding off on discounting older shoe models ahead of product updates. A New York State court judge issuing a restraining order on New York City Mamdani's pied-à-terre tax. The suing homeowners saying the city caused, quote, mass confusion with its controversial identification of thousands of properties that it says are potentially subject to the tax on second homes. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, the morning calls, plus Isabelle Freidheim of Athena Capital on big tech's massive capital raises and why the real AI infrastructure play lies still ahead. That's next. This is Bloomberg Surveillance.
Conditions for issuance within the AI data center build-out is wide open, but it's also coming at incrementally wider spreads. So there's both the availability of capital component and also the cost of capital component. Investors actually are demanding a little bit more spread for that investment.
That was Kelsey Berro of JPMorgan Asset Management ahead of what promises to be an ongoing busy slate of bond and equity offerings. This morning, you are seeing bonds and equities gain, at least in the front of the yield curve. You are seeing a 0.2% gain in the S&P. On the yield space, you are seeing almost a 2 basis point decline for the 10-year yield, 4.69%, with crude higher by 0.2%. Time now for the morning calls. First up, Morgan Stanley maintaining its overweight rating on SpaceX, saying the planned acquisition of Cursor could become a major part of its upside case. Those shares lower by about 0.5% this morning. Next up, Phillips Securities downgrading Airbnb to reduce, saying the company's businesses beyond rentals are unlikely to be material over the next 5 years. Those shares lower by almost 2% in pre-market trading. And finally, Bank of America downgrading AppLovin to neutral, citing growing risks to its revenue growth. Those shares down also by about 2% in pre-market trading. Wall Street is going all in on the AI investment boom. NVIDIA lining up a $500 billion financing coalition as Intel pulls in $20 billion through an upsized equity sale. Bloomberg's Ed Ludlow joins us now. Ed, what do we know about this $500 billion financing plan struck between NVIDIA and 6 Wall Street behemoths?
Yeah, the pitch is that it takes NVIDIA compute and turns it into an investable infrastructure asset class of its own, just like Wall Street would finance the purchase of aeroplanes or other big capital projects that relate to very large infrastructure. The detail that Bloomberg's reporting and what sources tell us is that it will work like this. SPVs borrow tens of billions of dollars. The NVIDIA compute itself is the collateral, and then it's leased to an NVIDIA customer. But the thing that NVIDIA is really emphasizing, as well as Jensen Huang, the CEO, is that this is third-party capital, right? The $500 billion comes from the outside, and so there's a degree of separation from NVIDIA directly financing its own customers, which brings us back to the sort of circular financing debate. But, you know, the key message that kind of emerged last night was no one said no to this on Wall Street, right? Everyone wanted to participate.
Ed Ludlow of Bloomberg, thank you so much for being with us. And ultimately, that has been the story, that nobody wants to miss out on an opportunity. Isabelle Freidheim of Athena Capital seeing opportunities ahead in the AI build-out. She writes, as infrastructure names come to market over the next few years, they will offer investors cleaner, earlier exposure to AI's growth phase instead of late entry into already priced narratives. Isabelle joins us now for more. Isabelle, thank you so much for being with us. Let's start there. This idea that some people might be getting into the wrong areas after a lot of the gains have already been had. What are those areas that you think are kind of already fully priced?
Hi, thank you. So it is essentially the model layer. So the model layer has been built and funded and entirely repriced outside the public markets. So what reaches the public tape is essentially at this point a liquidity event, not a capital raise. So the opportunity left isn't so much the models and the quality of the technology, it's the companies that get paid deploying AI, whichever model wins.
At this point, you see, in other words, that public markets might not offer the same kind of advantage. But in private markets, there are questions about how much more risk is being taken on. Where in private markets do you see opportunities still remaining, even with everyone having their hand out?
There's a lot. So what is reaching the public markets is the tip of the iceberg. It's the LLM models. These technologies, again, have been built outside of the private markets, outside of the public markets. And now what is underneath is the entire foundation of the AI infrastructure. So it's power, cooling, electricity, inference, compression. This is where the value is now, to not make AI better, but how to make AI cheaper, accessible, functional, and profitable.
When it comes to this space, everyone questions the circularity of it, Isabelle. How concerned are you about that aspect of it?
The circularity of the technology?
No, of the financing, like NVIDIA is investing in their customers.
Yeah, so now the financing is moving away from pure equity financing and into debt financing. So a lot of the financing for the equity was previously funded by companies from their profits, right? So that includes SpaceX. For the first couple of years, they funded AI development from their internal profits. Then Google, Meta, all of this was funded before fundraisers came into the picture. Now, the AI infrastructure is what's currently being funded, and that's being funded by debt, which is really interesting because, of course, it's infrastructure. It's always funded by debt. But what's particularly interesting is that when you look at the big picture, debt is often a tool to tell the truth long term because there's no hope or hype. It's you get repaid or not. And the debt is now really anchored in the pure infrastructure layer. So it's no longer, it's not in the chips, right? Like this is not where you find the big landers. This is not where the opportunity is at this point. And the run rate for chips is actually, the half-life for chips is somewhat short. It's sort of 5 years, whereas the AI infrastructure and electrical grid is 10 plus years.
When it comes to things like data centers, et cetera, how are you viewing the risk factors when it comes to this build out in the United States when we've seen a lot more of a political backlash when it comes to things like AI and data centers and just frankly, Americans not wanting them on their block or in their backyard?
Yeah, well, that's one of many risk factors. But if you think about it, a good analogy would be fiber. So we laid far more fiber than anyone could use. The technology was very real and the demand did arrive, but it arrived late and it was financed with debt. So the builders eventually went bankrupt and someone else bought the network for pennies on the dollar and built the modern internet on it. So the asset wasn't necessarily a mistake, but the timing and the financing were. So that's what I see as one of the biggest risks at this point.
Do you have a top pick right now, Isabelle?
Again, we do like the infrastructure layer compression. We just invested in a compression company that shrinks large models by 80 to 90% with very minimal accuracy loss. Same intelligence, it really a fraction of the hardware and the power. So while everyone else is monetizing on the assumption that AI must be expensive, we are backing companies that prove that it doesn't have to be expensive and companies that are profitable.
Isabelle Freidheim of Athena Capital, thank you so much for being with us this morning as we prepare for additional capital raises from AI-related companies. Just getting these headlines right now. So talk about the whipsaw that we're seeing in headlines out of the Middle East, that the U.S. has fired on a ship that was breaking the blockade of Iran. This coming from sources. Again, this goes to the question of we had been seeing Pakistani officials saying that there was some good rhetoric coming between the U.S. and Iran. Now, according to an official cited by the Wall Street Journal, that the U.S. fired on a Panama flagged ship early this morning, Annmarie.
Yeah, so this this official is saying a U.S. military helicopter fired at the rudder of the ship after its crew ignored the warnings from the American personnel that are enforcing this blockade. And it sounds like that they were appearing to attempt a transfer of its crew to another vessel. What's interesting about all of this, and this coming right now at this moment in time, is that basically within the last hour, the market has interpreted headlines as a direction towards peace, and now once again a direction towards more conflict in the region.
You could see WTI now up almost 1%, and you could see this being being filtered into markets, diminishing some of the gains that we saw earlier as people reassess just how equal the idea of peace could be. Coming up in the next 30 minutes, Sophia Kearney-Lederman of FHN Financial saying inflation risks are to the upside ahead of CPI tomorrow. Some of these oil levels might not help with that. Plus, Yahira Anand with your morning movers. Swiss sneaker maker On falling after delivering a sales disappointment. The whipsaw nature of the headlines this morning is sort of indicative of the whipsaw year we've had when it comes to the Middle East. Earlier this morning, we saw that Pakistani officials were talking about a possible peace agreement between the U.S. and Iran. Then we got a headline talking about the U.S. ships in the region firing on a Panama flag ship that was breaking its blockade of Iran. You flip this through, and the stock gains remain, and they have taken hold. S&P futures still higher by 0.1%. Nasdaq futures higher by 0.3%. In the bond space, though, it has taken some of the heat potentially off, given the fact that people are looking more to the peace side than potentially the firing side, with yields lower across the curve. 2s, 10s, and 30s all lower by about a basis point. In the oil space, though, this is actually really interesting. Who listens to what? You are seeing oil prices essentially do nothing on the heels of conflicting messages, Annmarie, that we're getting this morning from both Pakistan and then this latest report from the Wall Street Journal.
What do you do with this? 45 minutes ago, things are shaping up in the favor of peace coming from Pakistan. And now we actually see the Wall Street Journal reporting that there's been more conflict and firing upon a ship because they were trying to go through the blockade and decided to, according to this official speaking to the Wall Street Journal, decided to not heed those warnings from the U.S. military. Well, it remains clear that this is just going to be incredibly messy, which is why when you look at surveys from CEOs, they're preparing for this to last through the year and next year.
And the reason why we've seen oil prices remain at a level that keeps pressure on inflation but isn't so high that it necessarily creates demand destruction. 1 hour away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. Supermicro reports after the bell today, and ahead of that, some optimism. We're seeing shares up 1.7% in the pre-market, and that optimism, of course, coming from the enormous amount of spending by the hyperscalers. And Supermicro, an AI server maker, is on the receiving end of some of that spending. Bloomberg Intelligence expects the company to beat on both the top and bottom lines, and that's because it already gave us an early look at bookings, saying that it booked more than $60 billion in new orders this quarter. Meanwhile, turning to the earnings we've gotten this morning, USA Rare Earths falling 4.3% in the pre-market after its quarterly loss widened. Remember, this is a company that received U.S. government backing up to $1.6 billion worth, so that support means a lot more scrutiny, especially when it does not deliver. And we end on another earnings story with On, the running company, shares plunging nearly 17% in the pre-market after the company slightly lowered its growth outlook. And the problem here is this tug of war between On and the retailers where it sells its shoes. The U.S. sneaker market is heavily promotioned right now, and On wants to maintain its premium reputation. So ahead of new product launches, it hasn't been sending out its new shoes, trying to avoid that discounting, but that just means less shoes in stores, and that weighed on sales this past quarter. Lisa.
Thank you so much, Yahaira. Meanwhile, Cleveland Fed President Beth Hammack doubling down on last month's dissent, saying some number of rate hikes may be necessary to tame inflation. Bloomberg's Michael McKee has more. Hey, Mike.
Good morning. I think that some people on Wall Street maybe haven't internalized the argument that Hammack and Lori Logan of Dallas, Jeff Schmidt of Kansas City are making, that it's not just a question of looking through oil prices or tariffs. It's a question of underlying inflation that isn't going down. Even if we get a drop tomorrow to 3.4% annual rate in CPI, that's still a problem, which is why Hammack and others will be looking at the old friend, CPI Supercore. As you can see there, it has been coming down, but then it went back up again when the war started. And now, even though the last month it went down, it is still in the threes, and that's too high for them. They feel like there needs to be pressure on the economy, more pressure on the economy to bring down rates. Now, does it mean we're going to see any kind of change in Fed funds futures tomorrow? I doubt it, because we've got a lot of inflation indicators still to go. On Thursday, we get PPI, then end of the month PCE, and then another PPI and another CPI before the next Fed meeting. So a lot of inflation data, and you won't get this one-off effect. It'll be a trend that they are looking at. Also, we have to point out that even if you're looking through oil and gasoline, prices are having an effect on consumer spending. And they may have an effect when we get to Thursday's Friday, rather, its release on retail sales. You can see the forecast for retail sales is very weak, but then when you take out autos and gas, it's a little bit higher for both June and July, and the control group was significantly higher in June. We'll see if that holds for July as well. Control is the part of retail sales that goes into GDP. So Americans have been spending still, even outside of what they're putting into their gas tank. The question is, does that continue now that during July we saw gas prices go up again?
Michael McKee, thank you so much. Love the chart. CPI, PPI, PCE, CPI, PPI. It's hard to get your mind around all of these acronyms. Sophia Kearney-Lederman, of FHN Financial, looking ahead to CPI data, writing, the big focus will be on whether June's broad-based decline was a one-off or not. There are still more upside risks to inflation than downside risks. This is the big debate. Sophia joins us now for more. Sophia, why do you see more upside risks to inflation than downside ones?
Well, thanks for having me this morning. I love that alphabet soup, CPI, PCE, PPI, PCE. I think the big thing is what we've seen even this morning, right? The volatility on oil prices. We know what we're coming into with the July data because we know where gas prices were, where oil prices were in July. On average, they were lower than they were in June. Not as much as June was in May, but we know we'll see a pullback. But now we're in August already, right? We've seen a lot of volatility. We've seen down, we've seen up. We're seeing a lot of movement this morning. And I think that is the lingering risk, right? And the bigger risk is not just oil, but it's the longer we're in this sustained level of volatile higher prices, what's the risk to pass through to the core, right? And that's the big question on that June number. June was surprisingly good, right? Broad-based declines outside of just energy. So good that we're waiting to see, was that a one-month fluke?
At this point, we've seen bond yields move up, particularly on the long end of the yield curve. And yet, a lot of people say that that's not exactly going to constrain either the spending coming from a lot of the hyperscalers or other AI-related companies, and it isn't curtailing consumer spending. So what exactly will higher rates do?
Yeah, I think that's a great question, right? And you saw Kevin Warsh even in the press conference suggest that the Fed didn't need to raise rates because of what we've seen on the long end of the yield curve. But you also haven't seen any pullback really in reaction to what that increase that we've seen, right? The 10-year, the 30-year trending higher in the last couple of weeks. And so the question is, are rates restrictive? And I think that's really what the Fed is grappling with, right? You have some people like Beth Hammack that are really concerned about the inflation piece, and other people that are looking at what we're seeing in growth and going, things aren't that restrictive yet, but we are seeing some sort of moderation, right? You look at sort of lower income spend versus higher income spend. You look at the concentration of where growth is coming from, and it's really all in that AI. But I don't think you're seeing any pullback from what we've seen in the long end of the curve yet.
Well, to Lisa's point, though, you have the likes of Beth Hammack saying that, it might even be, or it's going to be, she doesn't want to give a specific number, but it's going to be more than one hike. But to Lisa's point, if it's not going to curtail the big spenders, isn't this just going to hurt the people that actually desperately need lower interest rates, not higher?
Completely. And I think that's what's kind of the struggle for the Fed, right? This question of, if we raise rates, will it really do what we need to have done? If we raise rates, will that see the short end come up? Yes. Who will that hurt most? To your point, consumers. Consumers are the ones that are struggling the most right now, right? You have everyone sort of struggling with the cost of living issue and gas prices. But I think, will it impact what we've seen from the AI build-out? Not necessarily. And I think that's a little bit of what Warsh was kind of getting at, this idea that the market is sort of sorting itself out the way maybe the market should, and should the Fed necessarily interact on the front end of the curve?
What are you expecting this year from the Fed?
I think we see them on hold. I think September sitting at roughly 50-50. When you look at market pricing right now, I think we have that slew of inflation data coming in. This will be the first piece that we get this week. And so, yes, it will be important, but they'll get another CPI, another PPI, another PCE, another employment report, right? And so all of those things will factor in. I think we're going to see a pretty benign report this week, which will be a good thing. And so we think the Fed is probably going to remain on hold in September. I can think the really big question becomes, do we see oil prices go even higher? We've been in this volatile place, but if we can remain sort of where we are in this volatile place, we'll be okay. But the question is, do we see that continue to filter into the core? But our forecast is for the remainder of the year on hold, and a lot of that coming down to, again, this sort of two camps on the Fed, right, where you have some worried about the short-term inflation impacts and some worried or more focused on maybe the long-term impacts of things like AI that are actually going to bring inflation down in the longer term.
We started the show talking to Marvin Lowe about how the Fed should probably take a look at some of the AI spending, particularly on semiconductors and other component parts.
Chipflation.
And talk and consider tightening policy in order to constrain marginal borrowers from flooding the market and really bidding up some of these prices. Do you agree with that?
I do think that the short-term risks are inflationary, without a doubt, from what we're seeing, and the Fed might need to step in, right? I think if we see some of this sort of high level of borrowing impact supply and demand, right, and you're already seeing it again in that chipflation, if you see that again start to creep into the headlines, start to creep into core inflation, that really does become a risk. And again, I think we're seeing this really concentrated growth, really concentrated investment in AI, and there are supply and demand issues, right? We're seeing it right now. You look at, for example, hiring. One of the biggest gains was in construction workers for non-specialty contractors. A lot of that tied to AI build out, right? So there is that risk that you start to see that imbalance. And so I do think it's good that you have Fed officials that are talking about this risk and that are weary that in the short run, they might have to be reactive. I don't think we're there yet, but I think it's very good that they're paying attention to that.
Sophia, great to see you. Thank you so much for being with us this morning. Sophia Kearney-Lederman of FHN Financial with us here in New York. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. Oil rising following a report of rising tensions in the Strait of Hormuz. The Wall Street Journal reporting the U.S. fired on a Panama-flagged ship early this morning. The attack coming shortly after a report from Pakistan that the U.S. and Iran were, quote, close to some arrangement. New details emerging about how President Donald Trump flew out of Turkey last month. The Washington Post reported Trump boarded Air Force One in Ankara, then moved into a catering container attached to the plane, which then ferried him to a smaller aircraft that flew him to Britain. McDonald's stepping up its drinks options. The fast food giant adding a new Red Bull Dragonberry Energizer to the menu starting next week. It will also add an option to add vanilla flavor and cold foam to Coca-Cola drinks at some locations. And that's your Bloomberg Brief. Lisa.
Thank you so much, Giovanni. Up next, setting up for the day ahead, plus Kristen Bitterly of Citi staying bullish on the AI theme. We'll be talking about all of those debt and equity sales coming up. This is Bloomberg Surveillance. Good morning.
There is a supply issue that is arising ultimately with all of this AI build out. The demand for capital certainly are at levels that we haven't seen in quite some time. This isn't like prior investment cycles around technology. It's being embarked upon by companies that are incredibly cash flow positive. And that is somewhat sustainable.
And that was Marvin Lowe of State Street. Somewhat sustainable is another way of saying that everyone is selling and a lot of people keep on buying. Right now, when you take a look at markets, inflected upward to start the day. We are about 0.5% away from all-time highs in the S&P. Clawing back, some of that getting close to that up to 0.1%. Seeing the 10-year lower now by a basis point in the wake of fluctuating crude prices and expectations for CPI tomorrow, 4.69%. Crude up 0.4%, counting down to the opening bell. Here's a trading diary for the week ahead. After the closing bell, earnings from CoreWeave and Supermicro on Wednesday. We've got CPI, the main data point, plus PPI data on Thursday. Another round of jobless claims and Fed speak from Beth Hammack of the Cleveland Fed, who's made a lot of waves over the past couple of days, as well as Tom Barkin of the Richmond Fed. Friday, retail sales and the University of Michigan sentiment survey. Right now, stocks climbing into the opening bell with AI demand front and center. Kristen Bitterly of Citi writing, strong earnings delivery, accelerating cloud growth, and sustained AI demand reinforce our overweight to U.S. large cap equities and preference for AI-related themes. Kristen joins us now for more. Kristen, great to see you. Thank you for being here.
Good to see you, too. Thank you.
So I want to start on at what point some of the incredible bond and stock issuance starts to get you worried, considering that we're talking about a $500 billion facility for NVIDIA with 6 different banks.
I know. And I think when you look at like the original source of this investment, it was all being self-funded. It was free cash flow generation. And then we're moving into debt capital markets. I think you do have to ground yourself, though, in the earnings story. And this is why we're very comfortable where we're at, is if you look at the earnings story, particularly within the U.S. market, we have year-over-year earnings growth is 46% currently estimated. We have 9 out of 11 sectors that are delivering double-digit earnings growth right now. And so not only are you seeing it with the AI players, but you're seeing this broadening out that has real legs. So I think we have to stay grounded in what we know to be true. We have to stay grounded in the fundamentals. And even when we look at the interest rate dialogue around maybe rates are higher for longer, you can see that the market can withstand it, and certainly these companies can as well.
You're talking about earnings and the acceleration there. Mike Wilson was pointing out that the Russell 3000 saw the strongest earnings per share growth going back to 2021. You're seeing this pretty much across the board.
Yeah, outside of any recessionary kind of recovery period.
Correct.
Exactly.
Which is sort of unprecedented outside of any kind of recovery period. I just wonder how much of this is peak acceleration, right? I mean, is this, if stocks are a forward-looking mechanism, how much of this can get repeated considering the interest expense going forward, considering that some of the immediate gains from AI have already been had?
So I think the other thing that we have to look at is the fact that when we say we're investing in AI, it's not just the hyperscalers or the semis. You're actually looking at the entire ecosystem. And so if we believe that this is really an 8 to 10 year, maybe even 12 year kind of build out in time horizon, we're only in year 3 really of this. And so it's very early innings. So obviously from that perspective, there's going to be different pockets in different sectors that are outperforming or underperforming. But if you look at it in the entirety, that you're looking at resources, you're looking at power, you're looking at the infrastructure build out, I think that's where there continue to be opportunities. So you want to be diversified and not concentrated in one pocket of it, but we're still early innings.
We hear that a lot, that we're in early innings. At the same time, last week, there was a big debate about Sell America. Should that come back into that we saw last year? Should that come back into the fore for a lot of investors? You're not buying that, are you?
We are not. So when you look at Sell America, I think was really born out of, obviously, tariffs, very politically motivated. So good reason in terms of diversifying and diversification on a global basis. But I think when you're looking at like where is the innovation coming from, where are we seeing this level of earnings growth, it is an exclusive U.S. large cap story right now. And so if we continue to drive the innovation, we continue to drive the earnings growth, you need to be within the U.S. market, which is why we're comfortable with that overweight.
So how do you hedge?
Well, a couple of ways. I would say one, volatility is relatively muted right now. So when we look at the level of the VIX, if you are someone who is worried about some short-term impact, you can certainly go to the options market and use different strategies to just buy some downside protection and get through if there is a big catalyst event that you're concerned about. I would also say within our portfolios, we have 2 kind of key positions. One is gold. We still use gold as a ballast within our portfolios. You saw the central banks coming back and buying. It's not one of those things where we're forecasting out that this is going to be a bull trade. It's more as what is a diversifier in the portfolio. And then the other thing, and you guys have been talking about this all morning in terms of fixed income and looking at really looking at the different duration, we're around like 5.1 in our duration in our fixed income portfolio. So we are in the camp where because of volatility on inflation and some of that pressure, you don't want to really be out 10 years and beyond.
Well, this is the constraining potential factor for a lot of the ambitions. And at what point do you see the yield up, the move up in yields as being a constraining factor overall for the equity strength and frankly optimism that you feel?
I think on the debt side, you have to look at the interest coverage ratios. And looking right now where rates are today, those interest coverage ratios, there is plenty of liquidity and it's a de minimis amount. And so you have to keep an eye on that as you actually kind of like look as they issue more debt. Does all of a sudden, if rates continue to rise, does that become a more meaningful percentage? But right now, it's actually very, in my mind, it's relatively muted.
The idea of inflation, and Annmarie asked a good question, which is how do you hedge? And my immediate question is, what are you hedging against? Is it a downturn in growth or is it an upswing in inflation?
I think it's upswing in inflation is probably the bigger point of risk, hence the
gold.
Hence gold, hence our duration in our fixed income portfolios.
Well, and at the same time, a lot of analysts, and I'm thinking of your own at Citigroup, Andrew Hollenhorst, talking about the potential for the Fed to cut a couple of times and how actually core inflation is moving lower because of a lot of factors. I just wonder where inflation is coming from and whether it matters where it's coming from.
So I think running money and actually putting capital to work in terms of portfolios, you almost have to say, like, what are the risks that I'm hedging against? And so for us, it's kind of entrenched inflation is what we want to be prepared for, hence the positioning in our portfolios. I think, look, like tomorrow, you guys have been talking about this all morning. There's so many data points between now and the next Fed meeting that is tomorrow going to be a big event. If we see a little bit of cooling or continued cooling in inflation, could that be a net, I guess, neutral? Right? In terms of, I think it would be a very low probability we would get a cut, but is the Fed going to hold? Actually, your previous guest was saying this. Probably it's a hold when we look at the data and some deterioration in the labor market. But if inflation remains relatively muted, I think that puts them on a hold, not a cut trajectory.
Are your clients starting to focus on the midterm elections?
They are. They are. But
wow. Well, I know. Well, I'm wondering. I hear about it more.
I was told not to talk about it.
No,
until
not by
when?
me.
I was told by Jonathan Fair.
We can talk about anything. But what I will say, not when it comes to their portfolio decisions. So I think like the one delineating factor is it a topic of conversation? Of course. And you look at, some of the activity that we've seen over the past couple of weeks. But I think more than anything else, is it driving any type of rebalancing or portfolio decisions? Absolutely not. So again, it goes back to politics and how you're voting. Like we always say, like vote with your ballot, not with your portfolio. Right. And so I think like all of the themes that we just mentioned still remain very true.
But there is going to be an issue in the midterm elections when it comes to AI. We're seeing it in New York. There's a moratorium in terms of the AI build out. And that is, and we hear it from guests all the time in this program, that's not just a Democratic issue, that's a Republican issue. You're seeing this in red and blue states. Do you think at some point that's going to impact your decisions on the AI trade?
At this moment, no. I think, again, going back to where we see the flows, the investment, obviously you're seeing a lot of the large tech companies starting to actually invest locally in communities as well. So I think it's going to be a headline, but when it comes to actually detracting from the build out and the economic impact of that, I don't see that as a primary risk.
Anyone moving away from pied-à-terres in New York City? You don't have to answer that question. Kristen, literally.
I live here. I live here, Lisa.
I know. No, I know
so
you
I don't
do.
have a pied-à-terre.
I know you don't, but I'm just thinking that that's sort of probably part of the conversations that you're having with the ultra-wealthy individuals that are deciding where to invest and how to invest.
I would say, look, right now, I'm working with our Latin American private bank as well. And I will say that geographic diversity of where you hold your capital is a theme that started probably when we were talking about tariffs and kind of the sell U.S. But what's interesting there is like a lot of that geographic diversity is coming into the U.S.
Interesting.
So in terms of like offshore, so absolutely in terms of where you hold your assets is just as important as how you're invested.
Kristen Bitterly, thank you so much for being with us this
Thank
morning.
you.
Kristen Bitterly of Citigroup here as we chart towards CPI tomorrow, PPI on Thursday, CoreWeave and Supermicro after the bell, and a whole glut of bond and equity sales and deals that have come out tied to the AI build out. It seems to just be accelerating, not decelerating.
Yeah, the week is becoming a lot more interesting. Tomorrow will be anchored by CPI. That'll really set the tone. And also, I'm actually interested in the 30-year bond auction on Thursday. I don't say this a lot, but it actually is really interesting right now, given where the 30-year yields are trading.
Yeah, $25 billion of 30-year notes being sold on Thursday, with the potential that going forward, the Treasury Department might opt to actually shrink the size of that particular denomination's auction. Coming up tomorrow, Ed Yardeni of Yardeni Research, Amanda Lynham of Goldman Sachs, former Philadelphia Fed President Patrick Harker, and David Kelly of JPMorgan as we count you down to the CPI print. Getting a read on inflation, we get a couple of those, CPI, PPI, PCE, CPI, PPI. That's before the next Fed meeting. We can practice that in the break. From New York, this was Bloomberg Surveillance.